of the Banking Committee this Thursday, February 23rd. I'd like to thank everyone for being here today. Thank everyone for their patience over the last few days as we encountered some technological difficulties on Tuesday, and under our rules had a hard time trying to figure out if and how we could proceed. But today, as far as I've seen so far, we're going to knock on wood that everything is going smoothly. So looking forward to hearing testimony from everyone today on these bills. I'd like to continue by saying hello, introducing my co-chair, Senator Miller, who's joining us via Zoom today. Good afternoon, Senator Miller.
Good afternoon, Representative Doucette and the ranking members, as well as those of you who are in person and those of you who have joined us virtually. I'm sorry that I'm not able to be there today. And again, I want to extend my apologies as well for the snafu we had the other day. Thank you for your patience. And it's, you learn something new every day, right? And this is one of the things that we learned about virtual land and things that we have to try to put in place if we can to prevent such things from happening. But that was out of our control. So again, thank you for joining us. I'm excited to hear the testimonies today, which allows us to draft the bills that come out of this committee. So thank you very much for joining us. Thank you, Mr. Chair.
Thank you, Senator Miller. And Representative Delnicki, our ranking member, if you'd like to say hello.
Good afternoon to everybody. The other day, I think there was a Shakespearean quote, "Man plans and the gods laugh." And we sure saw that on Tuesday. But here we are today. We have our agenda in front of us. We have some interesting bills to discuss. And of course, we have people to testify, both here in person. Great to see that. And via Zoom as an alternative. So again, looking forward to an interesting afternoon. Thank you, Mr. Chair and Madam Chair.
All right, thanks, Rep. Delnicki. So we have 8 bills on our public hearing agenda today. What we are going to do in the interest of efficiency, I think, we don't have a heavy speaker list, but we do have quite a few speakers, either from the same organization or representing, the same interests working together, that I think in the interest of efficiency, it would be good to have folks come up and testify together. So we have several pairs of folks who I'm going to call up together on the list today. I think we'll allow 3 minutes. We typically allow 3 minutes for testimony, and then of course questions and answers. There's only a few of us here today, but I'd ask the committee members to try to keep it to 2 questions on the first round. Again, I don't think we're going to have too much of a time crunch today, so I expect that won't be an issue. With that, we're going to start. First on our list is Matt Smith from the Department of Banking. Okay, Matt.
It's been a while since I've been in this room, so just wanted to be sure I remembered. Good afternoon, everyone. Good afternoon, co-chairs Miller and Doucette, ranking members Brethel and Delnicki, and honorable members of the Banking Committee. My name is Matt Smith, and I am the Director for Government Relations and Consumer Affairs at the Connecticut Department of Banking. Thank you for the opportunity today to testify before you in support of Senate Bill 1019, an act concerning student loan servicers. This bill makes a conforming and clarifying change to our student loan servicer statute. Last year, the legislature passed our proposal requiring student loan servicers of federal student loans to be registered with rather than be licensed by the department. This change reflected a court decision which prohibited the department from enforcing the statute passed by the legislature in 2015, requiring vendors of the federal government to be licensed with us. This bill would make this applicable to subservicers to federal student loans as well. Section 1 makes this clarifying subservicer change to entities who are awarded contracts by the United States Department of Education, that they also be required to be registered with us as student loan servicers as well. So a subservicer is basically somebody who is servicing a loan on behalf of another servicer who is actually awarded the contract by the U.S. Department of Education. Section 2 amends notice requirements from federal student loan servicers to ensure that federal student loan subservicers are under the same obligation to notify the department of the expiration, revocation, or termination of a DOE contract, although they are not awarded the contract directly. Thank you. That's it. It's a small bill, but something that is important to the department to make sure that we make that clarifying change. And it's very good to be up here. It's very good to see everybody in person today.
All right. Thank you, Matt.
Thank you. I'm happy to answer any questions on this bill or anything else.
Yes, sir. No, I think your testimony is pretty straightforward on 1019. I did have one question on that. I wonder if you could just say it seems very straightforward. Expand on whether or not it's created any issues for the department in regulating servicers and why this change is necessary.
Nothing particularly pressing, but we did notice that last year it was honestly an oversight on our behalf that we didn't include this in the legislation from last year. So we just want to make sure, because some of these servicers are really big companies and they will often subcontract that work out, and we want to make sure that borrowers are working with companies that are registered here. So we just want to make that, even though the court decision limited our enforcement authority over servicers of federal student loans.
Right. Okay. Thank you. Makes sense. And while we have you here, just one more.
Sure.
I wonder if the department has a position, and it's okay if you don't at this time and want to get back to us on 6690 on our agenda today, which is the student loan registry and the ombudsman.
Yeah, sure. So we don't have a position currently, largely because a little disappointed that nobody has reached out to us about this bill. The proponents of the bill, nobody's talked to us about at the department about the bill. We saw part of this bill last year come up. Nobody had talked to us then, and nobody has talked to us since. So we would really like to get a better sense as what they're trying to achieve and how we can be helpful. Challenges of this bill are staffing issues. It does require additional staff for the department that aren't currently budgeted for. But on the flip side, before the meeting today, I'm encouraged that we actually did talk to some people. So we think that those lines of communication may start to be opened.
Okay. Yes, I certainly hope so. Thanks. Any other questions? Rep. Delnicki.
Thank you for being here, Matt.
Good to see you,
Really
Representative.
quick question pertaining to the registry of loan servicers. If a servicer chooses not to register, is there any enforcement issue there?
So yes, if they are required to be registered, and in that court decision that I referenced, while the courts upheld that we couldn't license vendors of the federal government, largely because different states may have different rules, and so that sort of exempted them out, as well as there were issues around privacy. So basically that case, I'm going to get into a little bit more detail than you probably want, but basically that case was predicated on the fact that in the DOE contract with the student loan servicer, they're required not to share information based on the Privacy Act of 1974 or 76, and it was like written into the contract. And here they had a competing regulator telling them, which was us, as they were licensed through us, saying we want those records. And the fact that you're licensed with us gives us the authority. So the case was predicated on like, how does this particular servicer respond to competing regulatory authorities, right? And basically the courts decided, they sort of split it down the middle. They said, we can't require license, but we can enforce our consumer protection laws. So if these servicers are not registered and they are violating any of our consumer protection laws around student loan servicing, we can we do have some enforcement power over them. It's a little bit easier if they're licensed with us, because licensure requires that they have to, that we can appear at any time. We do exams. They are compelled to give us records. In this structure, it's a little bit, it's more complaint driven. So we would have to rely on consumers to reach out to the department. If say the subservicer or the federal or the servicer isn't licensed with us and what they are. And then that requires us to use more of our subpoena and our investigatory powers rather than our licensure powers to adjudicate the complaint, which sounds all, I don't know, complicated, but that's essentially how we would approach that.
So the simple answer or the short answer is,
Short answer is
Yes.
yes, we can.
and you would be doing that based on some kind of administrative law?
It would be complaint driven based on our investigatory powers. I think it's invested in 36A-17. So it's in the banking law where we can pursue those that are subject to the jurisdiction of the commissioner.
Thank you for the answer, and thank you. for
Even if it's a
putting
little
my concern
long-winded.
aside.
Great.
Any
And
other
happy to answer any
questions?
other questions.
Any other questions? Anyone? Going once, going twice, seeing none. Appreciate it. And again, if you wouldn't mind following up with us on 6690. I don't know if you intend to submit testimony on that, but even if not,
We
we
will.
appreciate
We'll
having
be
a
in touch.
conversation. Because as I probably can see from our list today and the testimony that's been submitted, it's an issue of great interest.
Indeed. Thank you
Okay,
very
great.
much.
Thank you.
All right.
Okay, next, we're gonna start with one of our first panels. We have Fran Pastor, who is second on our list. And Fran is going to be joined virtually, isn't technology wonderful, by Joshua Miller and Awesta Sarkash. We have both of those individuals available. So what they would do, okay, they're in the Zoom room. So Fran, I'll have you go first, and then
Great.
we'll go to Joshua and then to Awesta.
Thank you, Chairman Doucette, Chairman Miller, Chairwoman Miller, Ranking Member Delnicki, and I think Ranking Member Berthel is here, and Vice Chair Santos, and members of the committee for the opportunity to testify before you today in support of SB 1032 as introduced by Mr. Doucette. My name is Fran Pastori, and I'm the founder and CEO of the Women's Business Development Council. The small business financing landscape has changed since the 2008 recession. And in Connecticut and across the country, we've seen new financing products and providers, including for-profit fintechs, enter the market. Some of these providers are using innovative technology to make affordable and responsible financing more accessible to the unbanked entrepreneurs that we at WBDC work with, while others are engaging in predatory and deceptive practices that leave businesses caught in an unsustainable cycle of debt. Entrepreneurs are committing to financial products with terms, structures, and penalties that they did not fully understand and find themselves paying off debt that they could never support. The consequences for small business borrowers can range from simply overpaying for financing to falling into an unaffordable debt trap and closing down, inevitably harming the business owners, their families, and their employees, and their livelihoods in their communities for decades. And that's what brings me here today to speak in favor of Representative Doucette's bill and to testify to the importance of transparency in small business lending. The entrepreneurs that we work with at WBDC are experts in their field and they know their craft, whether it be mechanical, engineering, or baking. but most do not have the infrastructure, such as attorneys, accountants on staff, who can guide them through often complicated commercial financing options and determine which is less expensive or best suited for them. So in 2022, there were 360,000 small businesses in Connecticut, according to the US SBA. Of the 360,000, nearly 41% were women-owned, 22.2% were Hispanic-owned, and racial minority-owned. These are the people that we at WBDC work with day in and day out for the state of Connecticut, in the state of Connecticut. Many open-ended credit providers and merchant cash advance providers prey on women-owned and Black and Hispanic-owned and other racial minority-owned small businesses. And many of us, technical assistants and CDFI providers across the state and the country, are working with these small business owners so that they can refinance their debt and actually stay in business. So without standardized pricing information in place, small businesses are inundated with potentially misleading rates, such as what is called a simple interest rate, a factor rate, a fee rate, and sometimes it just says rate. Small business owners tend to mistake these rates for the APR because APR disclosure is mandated for consumer financing. I think my time is up. So I just want to say I urge you to support this bill as it preys on the majority of the women and marginalized populations in our state. Thank you so much for the opportunity.
Thank you, Fran. And you can stay there. I suspect we'll have some questions. Like I said, we're going to hear from the panel. Did want to clarify one thing, though. You said Representative Doucette's bill. It is a committee bill.
Oh, sorry.
And besides that, it is actually a Senate bill, and I'm just the lowly House chair. So just want to clarify that.
Apologies. Haven't been in this building in 3 years, so.
Okay. Joshua, we'll hear from Joshua next.
Hello, members of the Joint Banking Committee on Banking. I am pleased to join you today in support of SB 1032, an act requiring certain financing disclosures. My name is Joshua Miller, and I'm the Vice President of Research and Policy at Axion Opportunity Fund, a leading nonprofit community development financial institution. We are a small business lender that provides free coaching, technical assistance, and capital to entrepreneurs nationwide. To date, we have deployed nearly $1 billion in capital to almost 25,000 entrepreneurs, and 90% of our clients are women, people of color, and people with low to moderate incomes. And we are expanding access to capital and to small businesses in Connecticut and have deployed over $1.3 million in the state with an average loan size of $34,000. As a founding member of the Responsible Business Lending Coalition, we are in support of SB 1032, which would extend truth in lending protections to small businesses across the state. All this bill does is tell small business owners the truth about how much it will cost them to access financing by requiring APR to be disclosed. There are over 360 small businesses in Connecticut, and each one are at risk of falling prey to obscure financial products with misleading rates and terms. And 43% of those businesses are owned by people of color. And it is these small businesses in particular that are targeted with misleading concepts such as the simple interest rate and factor rate, which misleads the borrower into believing that this is an APR. For example, we found that a 1.2 factor rate is really hiding a 70% APR. We even issued a research report on this type of financing and found that the average APR was 94%, reaching as high as 350%. You will have to judge for yourself on whether these APRs are too high. That's not why we are here. We are here just demanding that lenders disclose the APR to small businesses so they can make an informed decision about what's best for them. As a nonprofit lender, Axion Opportunity Fund makes loans to underserved small businesses all over the country. Small business lending to underserved communities is rewarding but challenging. Whether it's that food truck owner, that single parent running their own salon, or even an independent owner truck driver, they have placed their hopes, dreams, and future on the fact that small business lenders will be honest and transparent with them. That is why I implore you today to enact SB 1032, requiring the APR to be disclosed, which will empower good lenders to do right by small businesses and empower small business owners to access transparent capital and chase their dreams. Thank you.
Thank you, Joshua. Next, hear from Awesta.
Thank you so much, co-chairs Doucette and Miller, ranking members, and additional members of the committee. My name is Awesta Sarkash, and I'm the Public Policy Director for Small Business Majority. We're a national small business organization that empowers America's diverse entrepreneurs. I also serve on the executive committee for the Responsible Business Lending Coalition. Thank you for the opportunity to discuss SB 1032, which we feel would enact critical protections for small business borrowers in Connecticut that are falling prey to predatory lending practices. There are few protections provided to small business owners seeking financing because the Federal Truth in Lending Act does not apply to most commercial financing. The legislation modeled after very successful small business truth in lending laws enacted in California and New York would provide common sense protections for small business borrowers in the state. The bill is applicable to financing products below $2.5 million because smaller, true mom and pop Main Street businesses are the ones that are being misled by the lack of transparency today, which you've heard other folks already talk about. Essentially, the legislation provides transparency about the lending product, tells the online lender how to calculate the APR and what to disclose. The original rationale for not extending these types of disclosures and protections to commercial loan transactions was based on this belief that small businesses had greater financial expertise at their disposal, that they are controllers or chief financial officers on staff or CPAs who could provide financial advice when they stop financing. That may be true for some businesses, but for the majority of small businesses, it's not true. A majority of businesses are sole proprietors. They're not corporations. They operate home daycare centers, cleaning services, and so on. They're managing other finances using QuickBooks and often working in the evenings outside of their core hours. They may or may not have a part-time bookkeeper or accountant to help set up their books. The legislation is needed because small businesses in Connecticut could unknowingly agree to higher cost terms. We protect consumers when they search for a credit card or any type of capital that they need by disclosing APR. Shouldn't we be doing the same for small businesses? APR really is the only metric that enables an individual to make an apples-to-apples comparison among financing products with different fees, interests, and term lengths over a common unit of time. Has been documented and already mentioned, the Federal Reserve has indicated that most of these financing products shift people to higher cost financing products that may not actually be good for them and hinder the trajectory of their business. So please pass SB 1032, and please remember that the opposition is going to tell you that they're not going to be able to calculate APR, and that's 100% false. We've seen this in other states. California has already implemented this in December. And we've seen no evidence that lenders have left that market and that capital is inaccessible as a result. Thank you.
Thank you, Awesta, and thank you all for going together. I do have a few questions, probably actually one for each of you. Fran, thank you for joining us. It's good to have you here and to have some local perspective, because we did have discuss this bill last year, have some of the same folks. We have folks who have flown in from around the country for this conversation, which shows that it's important and shows that we're not the only ones dealing with it, of course. But I wanted to ask you if you have any local perspective or stories from businesses that you've worked with or part of your network that have had experiences with this type of product and what those experiences have been.
So since I became very familiar with this bill, Representative Doucette, what we have done at WBDC is created a call to action, and we are trying to, for purposes of getting this bill passed, is reaching out to our clients to ask them for specific stories. You can imagine that people are reluctant to share their stories for a variety of reasons. And the biggest one would be embarrassment, that they were kind of, coerced or bulldozed into something out of desperation, especially with what was going on during the pandemic. I'll take that a step further and say that during the pandemic, while many of the large banks were non-responsive or less responsive to the kind of Main Street businesses that myself and my colleagues are talking about today that really needed access to PPP, many of them did turn to some of these fintech businesses, and their experience was not great. I don't have stories because at that moment in time, during those first few months, when the PPP was out, it was a frantic time. But what did come to full light was that the people that needed the money most had the least resources and the least assistance in getting access to that money. And that is why at the Women's Business Development Council, our clientele has more than doubled since the beginning of the pandemic. And that's because people really need resources. They don't have, again, my colleagues already said this, they don't have a CPA on staff. They may not even have a banking relationship. Many of these small business owners don't use QuickBooks or Quicken, and they need the resources to help them do that. So it's so easy to fall prey to fast and quick money. But I am working on gathering real stories, and it's a matter of trust. So I'm really hopeful that we'll be able to get back to you on that.
No, I think you're absolutely right. In my experience and my interest in this, it also has seen the same thing, that there is some embarrassment and stigma associated with that for some of these borrowers who maybe, got themselves into something that they didn't understand. And are not necessarily wanting to share that experience with the world. I've seen that myself firsthand,
Absolutely.
so.
And I think they need a trusted entity that they can confide in and are willing to share that story, because I think this really exploded during COVID because of the desperation that so many Main Street businesses were experiencing.
Yep. Okay, thank you.
Thank you.
I did have a question. I think this is probably a good one for Joshua. You had mentioned APR versus what you were calling factoring calculations or other sort of metrics that could be used as alternatives. And I think we're going to continue to talk about this with other folks that are going to testify today. But I wondered if you wanted to expand on that and sort of explain that in a little more in layman's terms, how those metrics can be used to disclose the actual cost of the financing from your perspective.
From my perspective, the APR provides an apple to apples comparison for consumers to be able to assess which lending product is best for them. And one of the things that we found is they would end up with some type of lending contract where they would have like a percentage purchase price and they would have like a total cost price. And what wouldn't be disclosed is that they're actually paying 127% APR. The reason why that's problematic is the opponents of the APR will say, well, these aren't loans that are extended out to a year. What often happens is because of the payment cycle of these loans, a lot of these loans are paid over an annual time period. And so it's important for the borrower to understand what the actual cost of this loan will be and be able to compare that to other products.
Thank you. And then one more, and this was probably a good one for Awesta. Again, I think we're going to hear different perspectives on this perhaps, but I think you're probably the best person at this time to ask about the national perspective on this. California and New York have adopted something similar to what's in the current version of our bill, SB 1032. And we did hear also last year that there was it was slow to implement that legislation, but it seems that perhaps we have the benefit of having that experience, so perhaps we've caught up. And then on the other hand, there are other states that have done alternative things. So I wanted to give you a chance to maybe talk about that.
Sure. Yeah. So California has already implemented their program as of December 9th of last year. So they're already through the implementation process. It's already sort of in the works right now. New York goes into effect later this year, I think in August. But there are states across the country that are advancing similar bills to Connecticut, like Maryland, who want to protect small business owners in their states, because unfortunately there is no federal legislation that protects small businesses across the board. So I think in lieu of that federal law being passed, it's really critical to the safety of your small business ecosystems to pass a state bill. Keep in mind that there are, you mentioned other states that are advancing different types of bills. If the bill doesn't include APR, it is a bad bill. If it's not disclosing APR, it's a bad bill. Some states actually did try to advance some bills that included APR, and the opposition jumped in and tried to sort of pull APR out, and they were successful, unfortunately. And so those small businesses in those states do not have the same protection. So this is something that Joshua and I mentioned in our testimony, which is like APR is the only way for these small businesses to make a comparison. So we're a small business organization. We do free education and resources. And I think it was sometime last year, we did a national virtual event with small businesses, and we put up on our screen, okay, here's the APR for this loan amount, and here is a factor rate for this amount. Sorry, I was comparing factor rates. And we asked the people in the webinar, which one's the cheaper loan product? And nobody could get it because there's no way to compare. Like there's no understanding of like, what does 2% APR really mean? And that coupled with deceptive marketing practices really hinder a small business owner's ability to make an informed decision.
Thank you. Senator Miller.
Thank you, Mr. Chair. Thank you all for being here this afternoon. So I heard you, Ms. Sarkash, when you had mentioned that the opposition is saying that the APR could not be calculated. But what I find interesting is that individuals on your side of the debate are able to say that it's hidden and come up with a percentage. Like Mr. Miller stated 127% in APR. So I would be interested, and you can send it to me, and how do you come up with those figures? How do you unravel it so that you can determine that there is an APR, what individuals are being charged as an APR? And I will also be interested in, because California's law was last year, it was passed last year. And it took them, I guess, you said it was implemented December the 9th. And so I would like to know what some of those hurdles were and them trying to implement them. And in full transparency, I have met with the other side of the argument of this, and there seems to be, I guess they are interested in the Virginia model where you're right, in the Utah model where it's just disclosure. And so I would be very interested in your side and how this can be implemented. And with the APR and not necessarily the disclosure, because as we always says, there are always, not always, there are sometimes unintended consequences. And when it comes to people's money, I don't want there to be unintended consequences. So if we are going to do this, I want to get it right as much as we can the first time. So I would appreciate any information that you could send me so that we don't run into the same kind of hurdles that I guess New York is. I heard the rumor that they're having some issues in implementing theirs as well. So any information that you can send us to help this transition or the implementation of this bill, should it become law, to make it as seamless as possible. But I'm really interested in that APR piece and how do you calculate it? And the other side say that they can't. As you said, the deceptive marketing practices, especially since COVID, and Fran had stated too, about how the people that she served, that, they were preyed upon as well. And I can speak for myself, and I think my co-chair agrees, is that this is unacceptable in our state. And so we want to do whatever we can to protect the small businesses, because we all know that small businesses are the engine of this country, the economic engines of our country. And so we need to do whatever we can to protect them. And I think COVID has shed a light on this, as well as so many other issues that our people, and I should say residents of Connecticut as well as the United States, have experienced over years. And so this is an opportunity for us to try to get it right. So again, I thank you for bringing this to our attention again. I just felt, excuse me, I think we put it on hold last year because we do want to get it right. And so, I personally want to see what California and New York, I want to see their implementation and how it was working for them before we took this huge step. Thank you,
Definitely.
Mr. Chair.
And I'm happy to respond. Otherwise, I can. Okay, great. Thank you, Co-Chair Miller. A couple things. So there is calculation for APR in the legislation. It is modeled after New York and California, but we can follow up and share more information with you. Separately, in terms of New York, there really hasn't been any implementation issues. The sort of regulation process was deliberate to make sure all financing providers could calculate the APR and just understand the process. So that was mostly what the focus was. The implementation process didn't take especially long in our eyes. You also mentioned that Virginia's bill actually did start out with APR, but the opposition got to the bill and lobbied to remove it so that they didn't have to disclose APR. And they did the same thing in Utah as well. And so they're trying to make inroads to make sure that they don't have to disclose APR because they don't want to, because it's a deceptive practice. And so I think this is why we're sort of really honing in on Connecticut, because this is a great opportunity to really protect the small businesses and totally understand that like this was put on hold last year. Maryland did the same thing. And during that time, there most certainly will have been and will continue to be small businesses that are being taken advantage because it hasn't been passed yet. And so I think like if they're this is the right time to get it passed so that Connecticut small businesses are protected as they search for capital. And as you had mentioned, they're the lifeblood of our communities. They're the backbone of our economic drivers. And capital is basically the lifeblood of their business. And if they're signing on to something where there's 150% APR that they weren't aware of, there's prepayment penalties. It's good. It's going to drive them under for sure. So I appreciate you highlighting that issue.
Thank you, Mr. Chair. I may have another question after someone else speaks.
Okay, or you want to go now?
No, I'll wait.
Okay. I know Representative Delnicki has a question.
Thank you, Mr. Chair. So my understanding, and I think this came out last year, that there was a lawsuit going on in California pertaining to the legislation and the implementation. And has that lawsuit been settled, or is that still hanging? Can somebody answer that?
I'm not aware of the lawsuit that you're referencing. What I am aware of is efforts, I think specifically around New York, where there has, and I think this may have been what Senator Miller was referencing, where the opposition has filed a notice with the CFPB claiming that the federal TILA law preempts any effort to extend truth in lending protections to small businesses. And again, I'm not familiar with the specific lawsuit you're referencing, but what we do know is that there are efforts being made by the opposition to try to slow down any implementation of this law going state to state. And where they're unsuccessful in tearing APR out of the legislation, they are then making efforts to delay, allowing them to continue to gum up the works on the process.
Yeah, that lawsuit was filed by the opposition against the DFPI in California. And to Joshua's point, it's in an effort to delay. It's a tactic that they're using. They're trying to argue about First Amendment violations and so on. What Joshua also mentioned about preemption, but it's purely a delay tactic.
So then the short answer is the lawsuit has not been settled.
That's a good.
That's
Not
pretty
to our knowledge,
Yeah.
but we can get back to you.
response. There was reference to 360,000 small businesses here in Connecticut.
Mhm.
Do we have any idea how many folks, how many small businesses are actually using the product now? And is there any information pertaining to failure rates and any complaints that had been filed?
Representative Delnicki, I am unfamiliar with anything like that, and I would venture to say we probably don't know how many businesses are using any type of a product for a variety of reasons, and I guess one would be privacy. So I'm not aware of that at all. Great question.
Yeah, and quite frankly, I probably should have asked Matt Smith when he was up testifying. But then again, it would take some research to even find out if there was a complaint,
Yeah,
because that would probably be a good indicator of whether the product works or the product doesn't
Yes.
based on complaints that people have filed.
yes.
What we've seen in other states is sometimes the merchant cash advance companies will go after the small businesses once they've defaulted on an insane loan with insane APRs. So that I'm sure somewhere that information exists in Maryland, there's merchant cash advance companies that have filed lawsuits against dozens and dozens of small businesses. And I would be surprised if that's not also happening in Connecticut. And
Well-
you can do a Connecticut judiciary search to find that information.
Well, what I'm probably going to do my homework is probably contact the state banking department to find out whether there have been complaints there. Because I think that would be a reasonable indicator whether there's an issue here or not. And whether people have their eyes open or they don't
Mhm.
when they get into this. New York, there was talk of a lawsuit being filed there. Has a lawsuit been filed there?
My understanding is that a lawsuit has not been filed there. I would need to double check, but I would imagine it's another delay tactic by the opposition, but we can find out and get back to you.
Well, those are my questions. Thank you, Mr. Chair.
Thanks, Rep. Nikki. Any other questions for our panel? Senator Miller again. Thank you.
Thank you, Mr. Chair. Do you know or have any idea of how much money that industry would stand to lose should this bill become law?
From my perspective, we can't really say. What we would know is that if their business model is based on scamming people, then they probably will lose money. But if their business model is about providing access to capital that is fair and transparent, then they will find ways, just like many CDFI lenders, they will find ways to expand access to capital that is fair and transparent.
Right. Ms. Sarkash, I'm sorry, I'm trying to say your first name and last name at the same time. Do you have a comment on that?
I was just gonna say, I mean, I think definitely echo Joshua's point. But also for what it's worth, a lot of these merchant cash advance companies operate in multiple states. So if they are operating in California, they're gonna have to also, they're already disclosing APR. If they're also operating California and New York, they're gonna have to disclose in both of those states. So I'm not sure why they would, for whatever reason, not want to disclose in Connecticut unless they're a deceptive lender.
Thank you. That's all, Mr. Chair.
Thank you, Senator Miller. Okay, last chance. Anyone, any other questions? Seeing none. Thank you.
Thank
The
you.
three of you for your testimony and teaming up today as well.
Thank you.
Okay. Next on our list, we have another panel of sorts. We have Ann Watkins and also Krista Estrada Perez representing the Student Loan Fund. Okay, welcome.
Thank you for having me, dear members of the Banking Committee, Co-Chair Senator Miller and Representative Doucette. Thank you for having us in your space today as we talk a little bit more about the Student Loan Ombudsman and Private Lender Registry. My name is Krista Estrada Perez, and I am the Executive Director of the Student Loan Fund. SLF is a Connecticut borrower-led grassroots nonprofit, working to cancel student debt, make colleges and universities free, and fight for student borrowers' rights. My testimony reflects my experience working with borrowers from across the state. And as a person who's directly impacted by student debt, I am a first generation working class college graduate with over $75,000 in student debt from the University of St. Joseph's, with my mother who graduated at 45 from Goodwin College with $88,000 in student debt and a $15,000 Parent Plus loan for me. We have a combined student debt of $200,000 or more. Connecticut, just like my family, perfectly represents the grim reality of the student debt crisis. Nearly 500,000 Connecticut student borrowers and their families owe $17.5 billion in student loans. Although Connecticut was a pioneer and the first state in the nation to pass the Student Borrower Bill of Rights in 2015, we still need to make its promises a reality for borrowers in Connecticut. The lack of funding for a student loan ombudsman and a private lender registry has left Connecticut borrowers at risk. The higher education financing system has become more complex and overwhelming. Federal servicers have provided misinformation and bad advice to borrowers, adding more to their total debt and knocking borrowers off track for loan forgiveness. We have seen private lenders who have demonstrated illegal and unethical behavior, including predatory loans made for for-profit colleges that have defrauded students. In fact, we were just upstairs listening to the Stone Academy students and sort of what they've been experiencing. The need for help is actually evident. Through the Connecticut Public Service Loan Forgiveness Campaign last year, SLF and my partners supported over 3,000 borrowers through informational webinars and office hours, and had over 55,000 Connecticut borrowers visit our website, from borrowers looking for support, applying to the limited federal public service loan forgiveness waiver, whose deadline was last year, October 31st. We need to join other states in recognizing the severity of the issue, and we have to invest in our student borrowers. We know how impactful a student loan ombudsman can be. In California, the Department of Financial Protection offers webinars, trainings, and support to enroll borrowers in PSLF and Fresh Start programs. They help them understand their loans, rights, and options. New York, just across from us, holds workshops on financing, higher education, and repaying student loans. They resolve disputes, correct mistakes that may have happened with lenders, and explore repayment options or issues that have arisen from lenders. Similarly, establishing a private student lender registry is an effective yet easy to implement regulatory oversight over this industry. It helps student borrowers have more information, allowing them to choose a safe loan option that works for them. And it also helps legislators like yourself collect information and data necessary to inform future policymaking, to make sure that we are tending to those needs here in the state. With that, I urge the department and the committee to please support HB 6690 and to listen to some of the testimonies that we've been able to collect from borrowers from across the state. Thank you.
Thank you. Ann?
Thanks so much. We good? I think the last time I was here was the last day we were open before everything closed down. So it is a little weird. Good to be back in person. And thanks so much for having us. Co-Chair Senator Miller, Representative Doucette, members of the committee, ranking members. Thanks so much. My name is Ann Watkins. I live in New Haven, and I'm testifying in support of HB number 6690, an act establishing a student loan registry and an office of the student loan ombudsman. Krista has spoken really clearly and explicitly about the benefits of this. So and you have my testimony on file, so I'll just cut to the chase on a few different things. Just to echo one thing Krista said, well, I'm the founder and board member at Student Loan Fund, but we're advocating on behalf of Connecticut's 500,000 student loan borrowers, and they owe $17.5 billion. So this isn't a constituency that should go ignored. This is a large group of people. Connecticut really was at the forefront of serving student loan borrowers in 2015 when we passed that first Borrower's Bill of Rights. That was a great opportunity. And we just really are feeling like we're lagging, right? We've got another opportunity here with another bill to provide and fully fund the Student Loan Ombudsman Office. I really like this idea of showing what could happen if we had a student loan ombudsman. So we worked really hard during this PSLF, the Public Service Loan Forgiveness Campaign, with one staff member, one full paid staff member, and an enormous army of volunteers and a few allies from around the country. And you'll hear from some of them later. But we served 3,000 borrowers in individual sessions, small group sessions, webinars. We really served those borrowers well, and they needed that individual support or that group support. They needed access to online resources. Our website got over 1 million hits just from folks in this state who needed help with this really complicated borrowing system. Krister talked about California and New York. One thing that I really like to hear is in California, they say the Ombudsman Office says our job is to help Californians take the stress out of student loans, helping you find the support and information you need. Whether you need to stay on track or get back on it, we've got knowledge and expertise that can help. We're here to help you know your loan, know your rights, and know your options. Wouldn't that be great? Connecticut borrowers had that. In Virginia, borrowers can watch or read modules on every aspect of student loan borrowing and repayment. More importantly, borrowers can reach out to the student loan advocate with a specific question and are guaranteed a response from that office within 4 to 5 days. That's phenomenal. Those are phenomenal resources. The other thing these ombudsman's offices do is they reach out and provide resources to students before they borrow. So they do education with folks in high school who are looking at those student loans for the first time, for families trying to get a handle on what this means. We just really urge you to really, we've been here 3 years, I think. It's time to fully fund the Student Loan Ombudsman Office, and we really encourage you and support you in doing that. Thanks so much. We're happy to answer any questions you have too.
Thank you. Thank you. Appreciate your testimony. Appreciate your advocacy over that time in 2015. I wasn't up there then, but I know Senator, then Representative Lesser, I believe, was chairing this committee then, and he's constantly in my ear about it still. So you have an advocate there. But I appreciate your testimony being persistent. I was going to ask, and you touched on it a bit. I mean, I wanted you to relay, and maybe you said there's other borrowers who will be able to do so later. The experience and how having a dedicated ombudsman position would help our borrowers. But you touched on it, and the California and New York experience, and how those offices sort of function, and how they function with the PSLF. So that's I think that's a perfect example. One question I did have more specific drilling down. Do you know in the New York and the California office where that office is housed, where in state government it exists, and how it gets funded? Because that, as I understand it, over the years that I've been up here, that's been part of the issue here, to figure out, okay, where is this office housed and how is it funded? What we've proposed in the bill is to create a separate office. It says for administrative purposes only, which is something that does exist in Connecticut state government elsewhere, which I think would provide us with sort of the dedicated support and also a little bit of separation between the regulator and this entity's office. So I wonder if you're familiar with how New York and California kind of handle that within state government.
Yeah, I mean, I can, some of the more technical answers, we'll sort of leave it to our colleagues at the national level. But what I can say is that the Department of Financial Protection and Innovation, it's the one that sort of carries this work in California. And in New York, you have the Department of Financial Services, who are the ones who hold webinars and sort of have this. We reach out to them to see how their office operates. They originally started with one ombudsman person, one advocate. And since then, they have grown to 5 folks in their office doing this work. And to our knowledge, based on their information, all of them work with the public. And so they have a dedicated team of 5 through the Department of Financial Services, who do this work with student loan borrowers throughout New York.
I think in Colorado, it's the AG's office. And some states, I think also our Office of Higher Education. We've got a lot of options, right? I think that one thing to consider is what do we need to do to fully fund it, right? So that this person can actually serve borrowers. It isn't just a place that there's funding to support that person.
So, okay, thank you. Questions, Representative Delnicki.
Thank you, Mr. Chair. And, it's nice to see you in person, smiling face. And I want to thank you for your service on that task force that we had pertaining to the student loans and your good work there. What you say makes sense when it comes to having an ombudsman, so that folks that run into some problems there will have an opportunity to work them out. Government can be daunting many a time to try to figure out where you're going to go, how you're going to get help on something. So it does make sense, and I want to thank you for coming forward. Thank you, Mr. Chair.
Thank you, Rep. Delnicki. Any other questions? Anyone being online as well? Seeing none. I thank you for your testimony and your work on this issue over the years.
Thank you so much, everyone. Have a great day.
Okay. Next on my list, John Erlinghauser. John is here. Welcome, John.
Thank you very much. Good afternoon, everybody. My name is John Erlinghauser. I'm the Senior Director of Advocacy and Community Outreach for AARP in Connecticut. And I'm here to testify in support of Senate Bill 1018. Chairman Doucette, Senator Miller, Representative Delnicki, and Senator Berthel. It's really great to be here in person. Appreciate the opportunity to get back in the swing of things here. AARP is a nonpartisan social mission organization with a membership of people age 50 plus, with nearly 38 million members nationwide and about 600,000 here in the state of Connecticut. AARP supports livable communities for all ages, aging in place initiatives, financial opportunity, and resilience for everyone as they age and work and retire. We're before the General Assembly every year on a multitude of bills that support these issues. Consumer spending is responsible for more than 2/3 of U.S. economic output. Older adults are responsible for a disproportionate share of consumer spending. They represent a powerful force that is driving economic growth and value. This includes the products and services they purchase directly, as well as the further economic activity this spending generates. According to the AARP Longevity Economic Report, older adults contribute $8.3 trillion to the U.S. economy every year. That represents 40% of the total value of goods and services provided in the U.S. during the year, and that's also known as the gross domestic product. That is why it is critical that we put in place policies that protect consumers and do not disadvantage them and cause financial strain. Gift cards are financial products that have already been paid for. They are the equivalent of cash. In fact, they often say that on gift cards, protect them like cash. When there are very little money left on a consumer shouldn't be required to buy something for potentially more money in order to spend the small remaining balance on the gift card. And that's why AARP supports Senate Bill 1018, which increases the minimum balance amount for which a consumer using a gift card may request a cash refund from $3 to $5. This will put more money in their pockets, allowing them to spend it on necessities rather than being required to buy a product in a store that costs sometimes much more than the balance of the gift card. So once again, I want to thank the committee for raising this bill again, especially Senator Miller. I know it's been a cause of hers, and we appreciate the fact that she's championed it. So I'm happy to take any questions if there are any.
All right. Thank you, John. Appreciate you joining us today. I know we're not part of your regular rotation probably on the banking committee, but
We'll be back Tuesday.
I also have a feeling we're going to see you again. I was just going to say. Any questions for John? Any questions? Any questions? Nope. Seeing none.
Thank you very
Thank
much.
you, John. See you next week. All right. Next on my list is Peter Myers, CBIA.
Good afternoon.
Welcome, Pete.
It's my first time in front of the banking committee, so very excited here. Chairs, ranking members, and members of the banking committee. Thank you very much for the opportunity to testify today in support of Senate Bill 1020, an act establishing a first-time home buyers savings account and related tax deduction. This proposed legislation is a creative way to incentivize Connecticut residents to save and purchase for a home in Connecticut. CBIA members have identified the high cost of housing as one of the leading causes impeding the growth of Connecticut businesses. In January of 2023, home prices continued to rise from previous years as the reported median home price was up 4.9% year over year. This legislation would help to ease the cost of owning a home for Connecticut residents by creating a tax deductible first-time homebuyer savings account. Currently, the state of Connecticut has over 100,000 jobs open. In order to fill those jobs, we need to keep our workforce here, and we need to attract skilled out-of-state workers. To do that, we must create and pass legislation that would help to ease the cost of housing for Connecticut workers. The Connecticut business community is supportive of this legislation, which would help to ease the cost of purchasing a home for our state's workforce and residents. Thank you for your time.
Thank you, Peter. Was that the timer or was that I just heard some beeping. Seemed like it was quick, but I appreciate your brevity. Rep. Delnicki.
Thank you, Mr. Chair, and thank you, Peter, for coming forward. I think you summed it up pretty accurately. If we can get someone to move to Connecticut or stay in Connecticut, save for a down payment, and quite frankly, at this point in time, you've got certificates of deposit going for 4.5, 4.75, and buy a home, do you think that will have a good chance to keep that person here in Connecticut as a productive individual, perhaps have a family, settle down and stay here?
Absolutely. We also think that would be a great way for them to invest in the state of Connecticut and invest in growing businesses here and invest in being a resident here. Absolutely.
Well, I thank you for coming forward because quite frankly, that's the intent of the bill, to get somebody to either stay here or move here, have a family, raise them, and be a productive person in the state of Connecticut. Thank you.
Thanks, Rep. Delnicki. A lot we can agree on there, I think. Anyone else? Any other questions? Anyone? Okay, seeing none. Thank you, Peter.
Thank you very much.
All right. Next is Ben Shaken. Welcome, Ben. Good to see you. Again, probably not a part of your regular rotation around here, but we're glad to have you.
Thank you. Thank you, Mr. Chair. Good afternoon. You are correct. I think this is my second time in 9 sessions in front of the banking committee, but I'm glad to be here. Good afternoon to members of the committee. My name is Ben Shaken. I'm the Director of Government Relations at the Connecticut Community Nonprofit Alliance. The Alliance is the statewide association that represents community nonprofits who provide essential services in every city and town in Connecticut, serving 500,000 people in need, and importantly to my testimony today, employing 115,000 people across the state. I want to thank you for the opportunity to provide testimony in support of House Bill 6689, an act concerning CHESLA refinance loan subsidy for certain healthcare professionals. I don't think I need to tell many of you, nonprofits are facing a workforce crisis in this state. The nationwide exodus from the healthcare industry has been well documented, but it has hit Connecticut's nonprofits especially hard. Staff are leaving for higher paying jobs in private industry and in private practice, where for behavioral health professionals, they can deliver services remotely from their homes. In school districts are hiring clinical staff away. The state is hiring clinical staff, all taking staff away from community-based nonprofits. The costs of living adjustments that many of you supported in the last 2 state budgets, while very much appreciated, have been completely enveloped by 16% inflation. And unlike many other industries, nonprofits are paid for their services largely by the state and cannot unilaterally raise their prices to meet these rising costs. So it's in this context that creating a program like the one that's proposed in House Bill 6689 makes sense. Connecticut needs tools to attract new behavioral health staff from other states, and we need tools to incentivize new graduates from Connecticut to stay here. Creating a loan program where behavioral health professionals can refinance their loans into no interest or low interest loans would be really great mechanism to grow the behavioral health workforce. And I'll just say en masse with some information you are all probably more familiar with about student loans. About 14% of the Connecticut's residents owe student loan debt, and among those debtors, only 14% owe less than $5,000. The other thing that I will say is for those who have federal student loans, they have been in forbearance now for almost 3 years due to the pandemic. That will end probably finally with the winding down of the federal public health emergency over the next several months. And when it happens, about $200 million will be taken out of Connecticut's economy into student loan payments that folks have not been making, or not been being forced to make, at least or be required to make for the last 3 years. The only other thing I'll say about this bill, as it's drafted, it includes all people licensed under any of the different behavioral health licenses. And I think that is definitely one way to approach it. I just came from the Higher Education Committee that has a very similar proposal with slightly different criteria. And I'll wrap up just by saying that we would appreciate some conversation with the committee about ways to try to incentivize even further folks that hold those behavioral health licenses to qualify for either this program generally, or for a better rate in this program or something along those lines, if they choose to spend their careers not just being a behavioral health practitioner, but doing so in a community-based setting where they're serving Connecticut's most needy. So thank you very much for your consideration, and thanks for raising this bill.
Thanks, Ben. Appreciate your testimony. That's a good segue to the question I was going to ask. If you could, from some of your members in the Alliance, maybe if you have some examples of either the types of jobs or professionals that this would benefit, or the organizations, or both.
Yeah, definitely. So the bill as it's drafted pulls from the licensure statutes that govern who is qualified to become a licensed clinical social worker or licensed professional counselor, and the other different healthcare professions that are covered under that statute. For our members, for nonprofits that are providing behavioral health services, this is primarily folks that have a master's degree, people with at least a master's level of education, and then are graduating from that degree program and going to work in a community-based setting where they are not going to be expecting to become rich or become wealthy. Unlike many healthcare professions, where, after many years of schooling and a pretty significant debt load, folks can expect to earn a high income. Those that are working in the behavioral health profession, in particular, those that are working in the community-based system, don't have that expectation. And so they do, however, also carry a pretty significant debt load, and any support that they can have to pay it off would be helpful. By working in a nonprofit, they would also be qualified for the federal public student loan forgiveness program after 10 years or 120 months employed while making payments on their loans. And so I think part of the other thing to consider about this program is just to make sure, if possible, that the program wouldn't preclude folks from moving their federal loans out into the CHESLA program, because that would make them drop out of eligibility. I do think, though, that for the most part, a lot of people, especially those who don't have family support or individual ability to come up with funds for college, are taking private loans to pay for school, in addition to whatever federal loans they might qualify for. And those loans are, of course, not part of whatever the federal government has been able to do to ease the debt burden. And so having a program to help those folks in Connecticut would be really, really helpful.
Right. That's actually a really good point. Because you're right, there's private and federal, and maybe if someone is sophisticated enough, they could try to, not combine them, or to try to find different programs. Maybe this program works well. I mean, when we did think about this as we were drafting it, certainly work well for somebody who had private student loan debt, but your point about the forgiveness program is a good one. The only other thing I was just going to ask for you to touch on is in terms of hiring and retention, what the experience has been for those behavioral health professionals with the organizations that you represent.
Thanks. That's another great question. Hiring and retention have both been really, really significant challenges. In particular, for behavioral health staff, we are in a workforce shortage broadly in the state, and there's just a shortage of people who are qualified, particularly for folks who are bilingual, who nonprofits are required to have staff that speak other languages to serve many of the programs that under state contract. But just in general, it has been very difficult. Applications where, you used to get 40 or 50 people, you're now struggling to get 1 or 2. And that, and I'm not sure that that's a unique situation to nonprofits, but I think what is unique is because perhaps partially the focus has shifted in society so much to behavioral health needs, in part because of some of the policy decisions made in this legislature to incentivize school districts to hire more behavioral health professionals in particular, to incentivize folks to retire from state service and the state to then need to hire new people to replace staff in crucial roles. There's been a really significant pressure to hire people with clinical qualifications into positions that often pay better and offer better hours, either school hours or work from home options, the things that don't exist in community-based programs. And then there's also been a pressure as the healthcare world has shifted to telehealth and people have gotten, very rapidly much more comfortable with that. Telehealth companies are hiring licensed clinicians and you can work from home, you can set your hours and bill for services that way. And so all of those things have sort of created a perfect storm for behavioral health providers in particular. And it's why a program like this would be helpful, at least to get more people in the state if it's not limited to just nonprofit employees.
No, and then that was part of the impetus as well. And I figured you would touch on that it's part of the policies that we've been implementing, particularly last year's Bill 5001 that created a need for these behavioral health, mental health professionals. And it occurred to me, at least at the time, that this is a wonderful initiative. I just hope that we can find people to fill these roles that we desperately need. So that's part of the impetus. So I appreciate your testimony today. Any other questions for Ben? Rep. Delnicki.
Thank you, Mr. Chair. And Ben, thank you for coming forward. You may have answered the question and I might have missed it. Do we know how many health professionals we're shy of to fill the jobs that we currently need to be filled?
We do, but I don't have it off the top of my head, so I could get it to you. But yes, I think in general, the state, there are sort of general statistics about how short we are on behavioral health providers. I just don't know them off the top of my head.
Because that's the kind of information that I think would bolster the entire discussion pertaining to this bill, knowing how many folks we're short of and the obvious crisis it's creating. Thank you.
Thanks, Rep. Delnicki. And actually, I did have one more follow-up too, and I don't expect you to have this answer right now, but I would be interested to know within the Alliance how many people you think in your members would be eligible for this program. That would be having one of the licenses that's in the bill currently, and B, have student loan debt that they could potentially refinance. So if there was any way for you to poll even informally people to get just kind of an idea of what number as we're looking at.
Yeah, that is a good question as well. That one might be a little harder to pin down. We can certainly find out how many people hold the licenses in Connecticut. That's information that the Department of Public Health publishes. How many of those people hold student loan debt? It's not generally something, unless they're enrolled in the PSLF program and therefore asking their employer to certify employment every year to the federal government. I'm not sure that it's something that employers are tracking right now. But we can definitely come up with some sort of estimate of how many folks this would impact across the industry.
Okay, thank you. Any other questions? Seeing none. Okay, thank you, Ben.
Thank you. Have a
Appreciate your
great day.
testimony. All right, next up, we have Deveron Gibbons and Kate Fisher. Another one of our power panels today. Yeah. Welcome.
Thank you, members of
you.
the committee. My name is Kate Fisher. I'm a partner with the law firm Hudson Cook, and I represent the Revenue-Based Finance Coalition. We're a nonprofit group of responsible finance companies that provide capital to small and medium-sized businesses. Before I get to my prepared remarks, I'd like to acknowledge that you've heard this afternoon testimony that anyone who opposes the APR disclosure in SB 1032 is deceptive, scamming people, and 100% false. And I strongly object to that characterization. The Revenue-Based Financing Coalition opposes SB 1032 because of the estimated APR disclosure. That is what our issue is, because it will confuse our customers. An APR disclosure or calculation considers the interest charged, the required payment schedule, and the timing of payments in a loan term. And in a revenue-based financing transaction, there is no interest charged, and there's no required payment schedule, and there's no loan term. As a result, SB 1032 acknowledges that some estimates must be made in order to calculate an annualized rate, and that is why it's referred to as estimated APR in the legislation. An estimated APR disclosure is a calculation that will be made up of guesses or guesstimates. Estimated APR is not a true APR disclosure, and this will not result in helpful disclosures to business owners or our customers. In addition, requiring financing providers to give their customers a disclosure that they know will be wrong because it's based on a series of guesses creates significant litigation risk to financing providers. There's ongoing litigation in California now regarding this very issue, and there will be a cost to the state of Connecticut to draft regulations and enforce these complicated rules. Finally, the Uniform Law Commission, which is the body that drafted the Uniform Commercial Code, has recently formed a study committee on commercial financing disclosures to determine what disclosures would be most helpful to small businesses. The Uniform Law Commission is made up of lawyers from across the country, and there's a 9-member delegation from Connecticut on the Law Commission. And we respectfully ask this committee to allow the Uniform Law Commission to complete its study before passing legislation that may harm Connecticut small businesses. Thank you.
Devron, the floor is yours.
Good afternoon, members. My name is Devron Gibbons. I'm the CEO and Executive Director of the Revenue-Based Finance Coalition. And thank you for having us. I would just simply like to add a couple of things. APR, and I put it in the record, a report that was done by 11 Hispanic chambers across the country. I heard the young lady speak earlier about minorities. The Hispanic chambers across the country commissioned their own study with an economist to show why APR is not an accurate measurement to be utilized in this product. The other thing that I would add is if you look at these products and the folks that I represent, they're not loans, and you are trying to calculate them as such. It's a financing product. Ms. Fisher talked to you about earlier about there's not a January loan payment, a February loan payment. What happens in the product is we're buying future receivables. First of all, APR cannot be calculated on futures. So I don't know how you get to that math, but if someone could explain that to me, I would be more than happy to listen. The second thing is, again, we're back to it's a financing product. So guess what happens to small businesses? The reason that I think that they couldn't produce any people that have been harmed in Connecticut is because, quite frankly, if a business can't pay you back, we're buying future receivables. If a business can't pay in the month of February, guess what happens? They call into these companies that we represent, that I represent, and they say, we can't pay. And guess what we have to say? Okay, next month, what can you pay? Or when can you pay? We ebb and flow with businesses. We're betting on small businesses to be successful. That's why we have good underwriting, and we make sure that when we are giving money to these folks or financing money with these folks or buying their future receivables, we better do that very accurately and correctly, or we're going to put ourselves in a hole where we're going to lose money all the time. We wouldn't be sitting before you if companies were failing. We wouldn't be sitting before you if there was a bunch of people in this room saying that they have been harmed in some way, shape, or form by this product. And lastly, I would leave you with just think about this. If we can provide you with testimonials of folks who have used the product and they love it. And, you know, we don't have FDIC insurance like credit unions and banks and the other folks that they were up here talking. When we do this financing product, when we buy those future receivables, it is purely based upon what we feel, along with the business owner, along with the merchant, that they can accurately pay it back at in some way, shape, or form. And so we're taking that ride with the business and making sure they're successful. Thank you.
Thanks, Devon. Appreciate it. Couple of questions. So, you know, this gets down to the hyper technical issue of APR, and we could talk about APR all day, and we might lose people as their eyes glaze over, and they, as is the case with a lot of financial transactions and with a lot of disclosure discussions that we have. Because we have all sorts of financial transactions that people encounter every day, big ones and small ones. We have disclosure requirements. We can't force people to read all of those disclosure requirements. Often we can't force people certainly to understand all of those disclosure requirements, but that doesn't mean that we shouldn't be doing it. So I guess when we talk about APR, and I appreciate your point, you know, about it being an estimated RPI because APR because of the nature of this funding, the fact that it's not a closed-end loan, right? The question I keep coming back to is what do we have as an alternative? I'll let you talk about that for comparison's sake. You know, how does that get calculated? And then I guess most importantly, it gets to, I think, the fundamental question of why would that be a good or better way to measure the actual cost of capital of that loan when we have something like APR, which is used for a whole wide range of financial products. And then, you know, why is that not an apples to apples as opposed to an apples to oranges comparison? And is it because, this is my last question as part of this, is it because that on this product, the merchant cash advance product, that showing an APR shows that it's just really damn expensive?
I'm happy to
Yeah.
take
go ahead.
that. There are a lot of questions in there. I'm gonna take there was one question in there, what would be the more helpful disclosure? And then the last question was, I think something like, are we trying to not disclose that it's damned expensive? And I'm not sure about the damned expensive part, but I can say that a better metric is the total cost of capital. So whatever the expense is, it is disclosed. Here is the price. Your comment about APR, and before I respond, I really appreciate the willingness to dig into this issue of APR, estimated APR. It is complicated, and I, you know, applaud folks for getting in the weeds here. I spend my life in the weeds of APR. So APR is applied to credit transactions in the consumer finance space. In the commercial finance space, there are more types of financing products than just credit transactions. For example, there is accounts receivable invoice factoring. There is revenue-based financing. There are other types of products beyond the scope of what consumer finance covers. That is why APR does not work apples to apples, and why in this legislation there is APR and then estimated APR, recognizing that APR is not capable of being calculated with certainty for these products. Now, total cost of capital, what is the cost, is a metric that can be applied consistently across all of the different products, because we don't have the different concepts of, is it a an asset purchase? Is it a loan? It doesn't matter what type of financing product it is, because there is a dollar cost that can be disclosed upfront.
No, I appreciate that. I
Yeah.
guess I just keep coming back to the fact that the APR is sort of a commonly understood, whether or not it's fully comprehended, it's a commonly understood metric across a wide range of financial products, including, you know, adjustable rate loans. If you go get an adjustable rate mortgage, you have an estimated APR because we don't know what your interest rate is going to be in 5 years. No,
Mr.
go ahead,
Chair,
respond.
Again,
please.
Mr. Chair, you're talking about a loan. APR is not applicable to this type of product. It just doesn't work. I mean, I wish you could tell me today, well, I'll ask you a question and maybe this will help you. If you were going to a legislative conference in Texas, would you take a plane or a cab?
In Texas?
Yeah.
Yeah, no, I probably, unless I had time for a road trip, I'd
Yeah,
take a plane.
exactly. I mean, that is what you're trying to do. It's not apples to apples. It is not the proper metric. And in the record we submitted, an economist tells you that with 11 different chambers who deal with small businesses on a regular basis, that's their job, to deal with businesses, right? The 11 Hispanic chambers and business groups across the country have said this, to try to use APR is not an accurate measurement, simply for one reason and one reason alone. What if the financing that we produce for someone, they pay it back in 30 days? How can you use an annualized percentage rate? And that's what happens in most of these financing products. This is not an annual thing. You're trying to use something that you use on credit card transactions as opposed to a financing structure that doesn't have a loan every month, a loan payment date every month.
Right, but at the same time, on a credit card, you can have a balance on that card, so we know what the finite, you know, amount of the loan is. However, what we don't know is how much you're going to pay back each month, how much interest is going to accrue on that loan over the next year. But
Again, you just said a year,
right,
but we may
exactly.
not, you may not have this financing product for a year. It could be 90 days.
Right.
So you're trying to use a metric that is saying
I could only have a
annualized.
balance perhaps on my credit card for
But
90
what-
days before I
hear
pay
me
off.
out. You're saying annualized. You are saying that. I'm not saying it. Annualized.
Yeah.
That's a year's term. Most of these products may not go a year. Perfect example I'll give you, since the young lady was up earlier, she talked about these people don't know what they're doing. They're not business savvy. One of our companies, there was a gentleman who had a company in Florida. He utilized this product to buy gas futures. He locked in February of last year and he paid it all back. And guess what? His company did very well because gas prices fluctuated. These are very savvy business people. They know what they need.
Yeah.
If
Yeah.
you give them the right tools and metrics to be able to do that, they will do that. Other interesting thing is, if you look at Virginia, she talked about Virginia. You look at Virginia, they started out the same way this bill did. But Representative Tran saw that this is not the accurate measurement stick to be able to utilize to get that accomplished. That actually came out of a complaint, and there was no complaint here. And one other thing that I would add is the bill in California was passed in 2018, and it was not implemented until September of this year, which is 4 years. That's how difficult that is to try to utilize that particular piece of legislation, and they're in the lawsuit.
One other point I wanted to make, and then I'm going to open up to others. It's been going for a while. And a question as well. So we alluded to, and you alluded to earlier, the fact that there's not a room full of people who can show that they've been harmed here, that in a lot of cases, the lender is really partnering, and you have success stories. You detailed one of the guy who bought the oil futures. Part of my interest, and forgive me if you've heard this before, because I know we've talked once or twice, is that in this issue is that in my law practice, I represented a business, happened to be an old friend of mine, very successful restaurant business, who got themselves in a whole bunch of trouble with a merchant cash advance product. And the reason they did was because there was no disclosure that I'm aware of. There was no real understanding of how this product worked in the long term. And they really had not contemplated the consequences of what if it doesn't work. out the way. You know, we need cash quickly. We're going to fund it and we're just going to survive for another day and move on. And so this client of mine, again, my old friend, lost a very successful business because at the end of the day, they were left with a debt that they could never possibly repay. And, you know, again, we can talk about, you know, financial responsibility and everything else. We can talk, obviously, there's levels of sophistication across any business and sector and types of businesses. But again, I think the harm is out there. And as was alluded to earlier, these are not people that want to come here to test. Some may and some may not. But so I just want to make that point. And you can respond to that. And then the question, and then I'm going to pretty much shut up, is on collections. And you may not be able to answer this, but I read an article not too long ago that Connecticut is particularly unique in the respect that we offer what's called a prejudgment remedy in court, where a creditor can go to court and seize assets at the commencement of a lawsuit by filing a motion for what's called a prejudgment remedy. And that this in this sort of small business financing context, there's a particular opportunity for a creditor to come in and do that. And what we're talking about here are small businesses, mom and pops and restaurants and everything, who could find themselves in a position where they weren't successful and they weren't able to negotiate with their lender, and they find themselves losing their business. I don't know if you can comment on that and on the collections in Connecticut in particular.
Thank you for that. The Revenue-Based Finance Coalition is a strong proponent of disclosure. We believe in clear and accurate disclosures. We support disclosure legislation, and we are not here today saying that this concept of disclosure is a problem. It is just this very narrow estimated APR disclosure that we're talking about today. So certainly robust disclosures are important and we support them. Your question about the particular Connecticut prejudgment remedy, I'm not a collections attorney and I'm not licensed to practice in Connecticut, so I don't know the specifics, but I can also say that we support responsible collections practices. So that also is something that we would be supportive of responsible guardrails on collections practices.
Thank you. Questions? Rep. Delnicki.
Thank you, Mr. Chair, and thank you for coming forward. We had earlier testimony that in essence, it was a predatory lending program. Can you comment on that? Because that's what it struck me based on the earlier testimony.
I have, I've been in a lot of roles across the country and served in a lot of places. And I would tell you that there's nothing predatory about this practice of what the chairman would call merchant cash advance. It's revenue-based financing, honestly. And the other thing that the reason I would say that is we don't hold anything hostage. We don't get an equity position in the company. It's not factoring. So we're not holding the kitchen hostage in terms of equipment. We are taking a risk and a ride and betting that small businesses are successful. So I don't know how we could be predatory when we're not getting an equity position in the company. We're not holding a board position. We don't get to make any decisions. We don't get to hold the equipment in the company or business that we're doing as some type of liquidity, so that if something happens that we would be able to snatch those things back. So predatory to me is you are getting into a loan or something or any type of financing, you don't know the terms, and then also you're going to end up losing your business because we're going to own all your assets, and that's not the case with this product. It's just not true.
And thank you for clearing that up, because it's important to get an understanding of exactly what you do. And you made reference to Hispanic Chambers of Commerce. And maybe you can expand on that. How many small businesses there that have been helped by this? And how you've actually benefited the underserved communities? Can you address that?
Yes, sir. So there are, let me make sure I got it right because I want to give you the right number. I'll read them to you. The Commission of Chambers and Business Groups that commissioned the report were the Florida Hispanic Chamber, the Florida Hispanic Chamber, Chamber of Commerce, the Bronx Hispanic Chamber, the Latin Business Association in Georgia, the Hispanic Business Alliance in California, TAMAC, which is the Texas Minority Business Association, the Kansas City Hispanic Chamber, the Illinois Hispanic Chamber, and the New Jersey Hispanic Chamber. They thought that enough of the product and that a lot of their members, thousands of their members across these states have utilized these products and thought that we better commission something or have somebody get us a good understanding of what this product is and what is the most accurate metric to be able to be utilized as a good measuring stick to make sure people can understand what they're getting. Ms. Fisher talked earlier about total cost of capital. That's the most accurate way of being able to tell you on a daily basis, right? Because we don't know, they could have a business could have a great week and be able to pay back the financing that we've provided for them. The other thing is, remember the speed of service. The member has a good point. Speed of service for money for us is 24 to 72 hours. So when people are in need of cash, what's the most expensive money that a person can get? The money they don't have. And so they're out of business if you can't get to that. An example of that would be there was a person, an Amazon contractor that dealt with a company that is one of our member companies out in South Dakota. And he was an Amazon contractor in Arizona. He was bidding on an expansion of an Amazon facility on an Amazon contract. He was able to say that he would be in a month building the new facility and getting the trucks on the road. He won that bid because the other folks that bid on that contract were saying it was going to be 90 to 120 days before they could have the capital in their hands. This gentleman went on to win that contract in less than a year again. So it wasn't annualized. Less than a year, he was able to produce and pay back that type of financing. So I think that these folks, and there's nothing wrong with nonprofit groups. I work with them all the time. I have worked with them all on different things, but these groups are businesses join chambers because they want to have access and they want to have services and resources that they may or may not have in their particular communities or states, right? And they join them because they want the chamber to operate as a mouthpiece, help them with healthcare for their company, so many other things. And that these chambers thought enough to go out and say, well, here's what the most accurate metric is. Here's what we think is the most and highest best use of this product. And we have a bunch of folks using it, so we want to make sure that they're doing it accurately and right.
There was reference made to the cost of capital. And I'm not sure it was really explained in any depth so that we could get a full understanding, because yes, to the good chair's point, APR is easy to understand, but it sounds to me like that it's not appropriate for this product. But again, can you explain the total cost of capital in reference to what we've got here?
I can. Thank you. So the total cost of capital would be the showing the small business owner or medium-sized business owner shopping for financing, how much money they would be able to access, how much capital, what the total amount to be paid back would be, and any fees that are deducted upfront, fees or costs that are deducted from the proceeds of the financing. So it's a clear disclosure of any fees, and any payments, the amount of the payment. The piece we don't know is the timing, which is why estimated APR is a problem, but we know the amount. And in addition, and one of the things that Virginia has done, which I don't believe SB 1032 includes, is a broker fee disclosure. Because there are a number of brokers who assist small businesses in obtaining financing. And it's not always the case that the small business owner understands whether there's a fee paid to the broker. So that would be an additional data point that would be helpful for the total cost of capital.
I appreciate that explanation. You wanted to make a point?
I just add, Mr. Chair, remember, the interesting thing is, you talk about total cost of APR is an easy metric to understand. I'm an old football player, so Coach Spurrier would say, yeah, I'm an offensive player, but if you give me a defensive play, I understood it, but I probably couldn't execute it. And that's what we're doing here. We're using the wrong term and trying to execute something that it cannot be done.
So just one comment pertaining to what I've heard here today. So your product fits a situation where some business needs to get an influx of capital to do something that they couldn't do through, say, a normal borrowing opportunity based on a time frame. And it also creates a very unique way of paying it back. Is that a fair assertion?
Yes, sir.
Well, I certainly appreciate your comments there. Oh, California. I know there was a lawsuit last year going on. There was a challenge in court. Has that been settled? Do you know if that's been settled?
The lawsuit hasn't been settled in California. And again, the law that they were speaking about, the same law that they keep pointing to as a model, was passed in 2018. And the DFPI could not come up with accurate rules and be able to get it done until September of this year.
Yeah,
the
December.
2022. And so it took them 4.5 years to do that. And now they're in the middle of a lawsuit. And by the way, we are not suing them. The RBFC is not suing them. That is another group that is suing them. So, to say that we are trying to stall is not accurate. We were just in California, Ms. Fisher and I, and we are working with the Senate and the House in California to try to let the same APR disclosure sunset and start over because they are in the middle of a lawsuit.
Well, I appreciate you coming forward, testifying and giving us a detailed explanation of how the product works. Thank you, Mr. Chair.
Thank you, Rep. Delnicki. Senator Miller's online with the question.
Thank you, Mr. Chair, and good afternoon, Ms. Fisher and Devon. I'm sorry, Devon, forgot your last name. So I have a couple questions. Ms. Fisher, would you mind repeating what the total cost of capital is? I heard how much will the capital cost? They have in assets, I guess, and fees, and what the payments would be, and I guess you said broker fees as well?
Yeah, thank you, Senator Miller. So the total cost of capital is really the difference between what the business is receiving, the cash that they're receiving, and their payment obligation, what it will cost. And that includes fees that are deducted from the proceeds of the financing. So it is all fees. If it's a transaction that includes interest, it's all interest. It is any cost to that financing as a dollar amount.
And so you had mentioned disclosure that is easier to do. I'm sorry about the noise in the back. I can't have both mics on at the same. I have to have both of them on at the same time if you hear the noise. But the fees, the disclosure, like in Virginia, you're able to disclose all of the fees up front. Is that correct?
That's correct.
So one of the questions that I had asked the
presenters before you was, I didn't understand how could they identify what a product will cost. The APR is in one of your products and you're not able to identify. Can you speak to that at all?
Sure. Thank you for the question. So SB 1032 does not actually have an APR as applied to revenue-based financing and factoring. It is an estimated APR. So we start with the acknowledgement that it is not 100% accurate, right? We are estimating it. There are detailed rules for how a financing provider should engage in these estimates. And so I think of it as like choose your own adventure a little bit, because there are two options for how a financing provider can calculate the merchant's future anticipated revenue on which that financing provider would be required to base that estimated APR calculation. One of those, I believe, is based on the best information available to the financing provider. And I'm not sure what that means. It makes me uncomfortable as an attorney, because if someone asks, well, what is the best information available to me? What am I supposed to use? I'm not totally sure. Then the other way requires the financing provider to fix the number of months worth of financial data that the financing provider reviews. Although that number of months can differ depending on industry type or amount of the financing, and use that data to estimate the business financing applicant's future revenue. The result of that is that two financing providers who would be following these rules to the letter, looking at the same small business that they are giving these disclosures to, may have different estimated APRs. Because one may be basing it on 6 months worth of data, but another may be basing it on 4 months worth of data, or another may be using the best information available to them. And I don't know what that is. So the estimates are not an exact science. Does that answer your question?
Yes, it does. Thank you. The other question I had was, Devin, you had mentioned risk, that your product takes on a certain amount of risk. Can you talk about that a little, please?
Sure, Senator Miller, good to see you again. The risk that is associated, you remember, these companies that are applying this type of finance or utilizing this type of finance for small businesses have their own underwriting. So they better be very, very sure that the money they're putting on the street is the businesses who they say they are. They look back at their past receivables to see what they've done before. They make calculations based upon what businesses can really afford to pay back. So someone could come to one of these companies and really say, I need $500,000, but they would say, no, we only see, $100,000 worth of financing that we can provide for you. So the underwriting is pretty tough and pretty rigorous. And then when we put that money out, when the company sends that money to that account, there really is nothing, there is no leverage that the company has beyond the contract to try to collect anything. So and there's no equity, again, we don't hold any assets. So there's a lot of risk with that. There's no bank. This is not a bank. So there's not FDI insurance when something goes wrong or somebody to back that up. A good example of that is there was a company down in Florida that a restaurant, as a matter of fact, the co-chair talked about a restaurant that was blown away by the hurricane. They called into the company and said, hey, what do I owe? And the company said to them, you don't owe anything, because in the contract, it spells out if you go out of business at no fault to your own, then you don't owe anything. And so that's the kind of ride that we're taking with our businesses. We want them to be successful. Why would we finance deals and not have them be, not have the company be successful when we aren't gaining anything? We're not getting any assets. We're not going to go and take over the business. It really so there's a huge risk associated with the companies that are lending, or as the chair calls it, lending, but financing these deals. There's a huge risk because we don't know if they are going to go out of business next month or in 6 years. So yes, ma'am, that's the type of risk that we as our companies, our member companies, are taking on these different types of small businesses. And again, we want them to be successful because we don't get anything if they're not.
Thank you. If I may, Mr. Chair, continue with my line of questioning.
Proceed, yes.
Thank you. So you mentioned through no fault of your own. Is that standard language? And how do you determine if, the fault, where the fault lies?
Thank you. That's a really good question. In a purchase of future revenue transaction, there is no unconditional promise to repay. So there is no promise to pay back the money. Rather, the promise is to deliver a percentage of revenue to the extent that revenue is generated. The business owner does make certain promises so that the financing provider receives the benefit of their bargain. For example, the business owner would promise that the business owner will not divert their revenue into a second bank account and then say, I'm failing, I'm going out of business, I can't pay you. The business owner and the financing provider must communicate so that there is an understanding of what the actual revenue is, because again, there's no payment obligation separate from the actual revenue. That's an example.
Okay, my last question. So I just want to make sure I understand this. And Mr. Gibbons made a reference to it regarding the restaurant that went out of business. So it's COVID-19. I've done everything I can to keep my business above water because I don't know about in your parts of the country, but we've had quite a few businesses who have been in restaurants that have been in businesses for years having to close. And so because of the economy, they've had to close their doors. And they've done everything, including coming to, not purchasing, but soliciting your product, and was granted the funding to do so. And they still could not make payments because they don't have the receipts, because your business is based on cash receipts. So your product. So I just need to understand. So if I found myself in that situation, are you saying that I don't owe you? They can't come after me. It's not against my credit history. They can't come after me for the monies that I owe. I just want to make sure I understand what you're saying. Thank you.
Yeah, thank you for the question. You understand it perfectly. The obligation is to deliver a percentage of revenue to the extent that revenue is created. So in our example, when restaurants could only go to takeout during the pandemic, at least where I lived in Maryland, that revenue then was compressed to what they could do for takeout because they didn't have indoor dining service. When restaurants were closed, there was no obligation to make payments at all. So you described it perfectly.
Okay, and that's my last question, Mr. Chair. Thank you and the committee for entertaining me.
Thank you, Senator Miller. Just one quick follow-up to that last point, if I may. If in a merchant cash advance situation, let's say I had a business, I was advanced $50,000 and I locked my doors tomorrow and went away. Are you saying there's no ability to recover there and there's no collections actions that would be taken against that business?
Sure. So the parties do promise to act in good faith. So if you sold $100,000 of your future revenue today and then tomorrow said, haha, and just lock the doors, that would not be acting in good faith. So that would be a breach of the agreement because the financing provider would not have received the benefit of their bargain. But if that business owner went out of business and they were, trying and could show that their revenue had decreased or stopped, absolutely, there would be no obligation to pay. And that's the risk that the financing provider takes.
Okay. I guess my only question to that would be if someone is in financial trouble, and again, they determine, maybe they've got other debt on their business, right? They determine days after taking $100,000 cash advance that, you know what, they're coming, I've got another lien on my equipment or something, and it's just not possible for me to continue. That you're saying that your companies would not elect to enforce their obligation, would not engage in any collections?
This is a strange hypothetical. I'm trying to follow, but I'm having a hard time following because a business owner would have to be able to demonstrate past performance, and then the financing provider would look at that performance to determine what the expected revenue was. Many times the business owner will also, as part of an application, say, I anticipate my revenue will be X, right? So in our hypothetical, someone would, what would they say? Like, I anticipate my revenue would be 0. Oh, I'm just not following.
Yeah, they anticipate their revenue would be as it has been for whatever the course of the business was. But again, we're dealing with someone who's not a sophisticated business person. Maybe they didn't realize the extent to which their food or liquor distributor hasn't been paid and is coming to seize an asset that's instrumental to them continuing to operate their business.
Well, if
My point is you do collect in cases where someone is unable to repay. You do engage in collection actions, correct?
No, not
Never.
if someone is unable to repay. Now, I'm not a collections lawyer, right? But the obligation is not to pay, and inability to repay is not it's not an event of, it's not a breach of the contract.
Okay.
The only thing that would be a breach of the contract is if the business owner was generating revenue and diverting it, failing to send that 10% or whatever percent to the financing provider.
Okay. Well, again, I guess, and you admitted earlier that you don't have a lot of information on collections practices per se in the state of Connecticut. You don't have any.
Mr. Chair, I think the question is intellectually kind of dishonest. I mean, you're saying that a person doesn't know what's going on in their business and they're not savvy. And I think that is most of the people that we see they are very savvy. I don't think anyone would come and do this product and knowing that they have other liens and other things going on and they're in a downward spiral and then try to defraud the company that's financing them, because that's what it sounds like you're asking. If they openly defraud us, then we're okay with not.
I'm asking if you if your companies engage in collection activity, if they try to enforce the obligation. You made it sound as if it never, somebody, falls on hard times, that's fine. We're out. We're cool. Have a nice life. And that's not the case. That can't be the case.
So we are buying a future receivable. If they don't produce the future receivables, we cannot collect. It's just that simple. What you're asking is a question that cannot really be answered because there are so many hypotheticals that you can throw at us and throw at anybody else. And we would have to say, yes, we would collect in that particular case. Each company has their own collection practices. And so we can't speak to every one of these companies that we represent and what their collection practices are. But you're asking a very specific question. If the receipts are not produced, I want to be clear. If the receipts are not produced, we cannot collect. It says it in the contract. If they're acting in good faith and they are trying to run their business and they cannot make it work, then we cannot collect.
Okay, so you're telling me if I was to jump on the Connecticut Judicial website right now and to do a search for merchant cash advance companies, that I would find 0 collection actions against any of the companies that a MCA would be doing business
That is
with?
not what I said.
Okay,
I said each individual company
okay,
has their own collection practices, and each one of those situations would probably be different in each are a different extenuating circumstance. And if they were trying to collect, I bet you that there was something that happened in the contract that was not, that they didn't see that was right from the business owner, or the business owner didn't see that was right from us. Okay. That happens every day. If that were the case, there would be no need for lawyers if there weren't people that had differing opinions like you and I are having right now.
I just want to be clear, 'cause it would make it sound like there's never a case in which, okay.
And I want to be clear that we're not,
We belabored it.
and I want to be clear that we're not saying that. We're saying that people that act in good faith and utilize the product properly will not be collected upon because they have followed and engaged in the contract in good faith and tried to produce receipts.
Other questions? Representative Santos.
Thank you, Mr. Chairman. I really appreciate the conversation we're having on this, and like the good chair said, this is a topic that your eyes could probably glaze over a little bit, but I'm a nerd and I love this kind of stuff. I work in the banking world, so this is interesting to me. So many of the questions that were asked, Representative Delnicki asked very good questions. So did Chairwoman as well. And took some of my questions, but here's what I'm thinking. All right. And I get where you're coming from. I get where the chair is coming from as well. There has to be a number. I work with numbers, right? It's how my mind works. Is there a number that your coalition has on how many loans actually default? Is it a 10% rate? Is it a 5% rate? What would that be? Do you?
I don't know the answer, but I on a number, but default is not failing to pay. Default again is doing something intentionally depriving the financing provider from the benefit of their bargain, like diverting funds, things
I
like
get,
that.
okay.
Yeah.
All right.
And I think that, I'm speculating, but that would be a relatively low percentage because businesses are acting in good faith.
And so, okay, I understand that. Default to me is I can no longer pay. I owe you 100,000. How am I going to pay this back? Or what are you going to do to collect those funds back from me? That's where I'm coming from.
Oh, well, thank you for asking that question. So in revenue-based financing, in our example, let's say I'm not generating enough revenue.
Yeah.
Under the agreement, the business owner has the ability to have the payment adjusted so that it matches the percentage of their actual revenue. So
Okay.
if sales go down, that payment, they have the contractual right for the payment to go down. They don't have to engage in a workout. They have the right to say, here's my revenue today. 10% that I promised to deliver you is no longer whatever this payment is I'm making. It's X dollars. That's what I should be paying.
Okay. Right. Which is not what you would find with traditional financing. Your mortgage payment is 1,400, your, commercial loan payment is whatever it may be. And it doesn't matter what you brought in, you still have to pay that amount.
That's right. And this brings us back to estimated APR. That's why we can only estimate the APR because we don't know how long the term will be.
Yeah.
Because this ability to change the payment.
That's sort of where I was segueing because I understand the difficulty with estimating an APR when you don't know what's coming in, you don't know what the term length is. So I thank you for saying that. I know we covered a little bit the California law and the lawsuit. The 4 years of implementation there, brings me a little pause. Can you elaborate a little bit more on what it took? Why did it take that long to implement it?
Yes. So the California law was passed in 2018. The
Mhm.
California law actually does not require an APR disclosure. California's law requires an annualized rate disclosure.
Yeah.
And at the time that law was adopted, the bill author added a sunset of January 1st, 2024 to the annualized rate, because at that time, like today, there was a lot of controversy over how someone would calculate an annualized rate for products without a term. So the concept was, let's see how this goes. And it'll sunset in January 1, 2024, unless the legislature takes action. So that is still the state of the law today in California. The regulator, the DFPI in California, drafted rules creating this concept of APR and estimated APR for transactions without a term.
Mm.
It's very complicated, and it took them 4-something years. Now, COVID happened during that time.
Sure.
It's not as though they were, burning the midnight oil the entire time, but it was very complicated. So the law has just been in effect starting December 9th of 2022, even though the bill was passed in 2018.
Okay. What is the nature of the lawsuit at the moment? What are the folks claiming?
So I've only read what's publicly available. There are 2 arguments. One is that under the First Amendment of the U.S. Constitution, the government cannot compel financing providers to provide a disclosure they know to be incorrect, inaccurate.
Mm.
And so it's focused on this estimated APR, not APR as a whole,
Right.
just the small thing.
Yeah, that's the scope.
The
Okay.
the other is an argument that the Federal Truth in Lending Act preempts using the term APR in a manner that is different than APR is used in the federal consumer law. And I think someone mentioned the Consumer Financial Protection Bureau has indicated that its view is that it is not preempted. But that is the argument that APR has a specific meaning under the Truth in Lending Act. And as applied to loan products in the California law, it has that same meaning.
Mhm.
But when we have this estimated APR is when we create a conflict between the federal law and the state.
Okay, I could just a couple more questions. The Federal Commission's report. What's the timeline has been on that?
Oh, the Uniform Law
Yeah.
Commission, that's a great question. The Uniform Law Commission just created its study group. So I think it takes a year. I'm not sure, but I will be actively watching that. It will be a very interesting process because stakeholders will be invited. It's, a group of lawyers who are very focused on whether a uniform law would be helpful for interstate commerce.
Yeah.
So I'll be watching that with interest.
So thank you. Thank you for those answers. And just with a statement, I've seen sort of both sides of this, right? Where the person who is in dire need of some funding, gets themselves into a little bit of trouble. Not always the case being because of the loan, but because of pre-existing issues happening with the business. And that just happened to be the nail in the coffin, let's say, right? And then I also worry about the estimated APR, right? Where you don't know what it's going to be. And as a consumer myself and thinking of folks in perhaps my background, we want to know how much you're going to pay at the end of it, right? How much am I going to pay for this? And perhaps, you don't have the right appreciation for what exactly just a rate is, but I can tell you from my background, from my folks, my district, being Latino, we just want to know how much you want to. What's this going to cost me, right? And so I worry about these lawsuits, especially happening in the California law. And I've read up on the Virginia and the Utah law as well. So that's what my concern is. And so, I appreciate the back and forth. I appreciate your answers on this. I think we should just keep looking into it a little further.
Okay,
No,
sure.
I don't know.
I would just respond by saying, thank you, number one, but also, that's why total cost of capital is really the most accurate measurement stick for this. As Ms. Fisher talked about earlier, it allows for you to tell the amount that's being given to the business in terms of financing, all the fees associated, and what the cost of that is. So at the end of it, you know exactly what you're going to be paying back. I think that the chairperson earlier said it just cost a damn lot. Well, this is a way that you can see if it's gonna cost you a damn lot or not, right? You can just look at it and say, okay, here's what I'm getting, here are all the fees associated with it, and here's what at the end of the day I'm paying back total. I don't know of any plainer way of doing that. I mean, my uncle served in the legislature in Florida for a very long time, became the first African-American education commissioner since Reconstruction. And one of the things he always said to me is, Bubba, just make it simple, right? And that's what we're trying to do, make it simple for a business owner to understand what they're paying back.
Mhm.
One of the things in California that is very, very, very tough is the disclosures. And the other part of this, to comply with this law, is like you're giving a business owner like a 40-page document. Is it? What is it?
But I mean, in order to calculate the estimated APR, it's pages and pages of
Yeah.
how to do it.
Yeah, it's like
yeah.
40 something pages, and that doesn't seem plain and simple to me.
It's pretty complicated.
Yeah, look, I appreciate I appreciate that. And I know, not every single business owner is savvy enough to figure out exactly what something is going to be, right? I know you mentioned that you've got a lot of folks that come to you are very savvy. Some of the people that I deal with, they're not, right? So I think being honest and forthright with them is exactly where we're trying to come from. And hopefully and I could see that that's where you're trying to come from as well. So thank you, Mr. Chairman.
Thank you, Representative. I see Senator Miller has her hand up again. Senator Miller.
Yes, thank you for entertaining me once again. It's just a couple things popped up as I listened to the line of questioning. Kate, you had mentioned that the cash receipts, the payments can be reduced because since it's based on revenue, right? And if your cash receipts are reduced, then your payments are reduced. Is that correct?
That's correct, Senator Miller. The different contracts vary. There are some variations of this, but that is exactly the concept. So there are revenue-based financing transactions where the payments fluctuate every single day. It's based on, in our example of 10%, if the financing provider is buying 10% of the credit card revenue, every day they will get 10% of whatever that business had in credit card receipts during that day. So they really can't know what each day's payment would be. There are other types of transactions where there is a payment estimated at the beginning of the transaction that is debited. But if the receipts drop, then depending on the contract, either the payment would change or the business owner could get a refund.
Is there a penalty
No.
in those cases?
There's never a penalty. These transactions have to provide the merchant the ability to adjust the payment obligation with the actual revenue without any penalty.
Okay. And one last question. We talk about, we mentioned Virginia and Utah, where they're using a disclosure instrument. When is that disclosure given to the client? At what point in the transaction?
That's a really great question. So Virginia requires disclosure at the time of the offer. And I believe SB 32 has a similar concept. So the Virginia disclosure is given at the time that the business owner is presented with the offer of financing. The Utah disclosure requirement timing is more similar to the timing under the Consumer Truth in Lending Act, and that is at or before consummation or when the agreement is signed.
Thank you, and thank you, Mr. Chair.
Thank you, Madam Chair. Rep. Palillo?
Thank you, Mr. Chair, and most of the questions have been asked and answered, but you just mentioned no penalties. My question would be, you mentioned the flexibility and the ability to adjust if revenues are not meeting during the underwriting process or didn't meet the projections during the underwriting process. How does that affect the term? And so it may not be a penalty, but can you talk about the other modifications or the other moving targets that are there that are obviously going to affect if you're not looking at those revenues are not meeting the projections that your underwriters reviewed, then what are the other outstandings that are going to be changed or will be changed?
That is such a good question. And you have focused in on why estimated APR is problematic, because the only thing that adjusts is the term, right? There are not additional, there's not interest accruing over time. It is a fixed cost product. So if a business who has received one of these financing transactions, their revenue drops, their payment obligation is the same, right? It's a purchase of, let's say, $150,000 worth of future revenue. So the obligation is $150,000. And what changes is how long will it take to deliver that $150,000 based on the percentage of revenue. So for example, if the obligation is to deliver 10% of revenue and at the beginning, the parties project that each day's revenue will be $1,000. I have to keep the math simple. Then the obligation at the beginning would be $100 a day, 10%, as that revenue is generated, is delivered. Now, if revenue decreases, that obligation would decrease proportionately with the 10%. So if the revenue drops to, oh, I'm only making $500 a day in revenue from my business, then the payment obligation would change to $5, right? $50. Yeah, $50 a day. So that pushes out the term, but not the cost of the product.
Yeah, I guess my question with all of that, and not to belabor this, but if you just did the underwriting, and I'm not sure how long your underwriting process is, and then what the time frame of the payback is going to be, or the pledge on the revenues is going to be, you'd probably be noticing that upfront in some of the underwriting. So it just seems to be that you're making that change, and folks then come back to you, and I'm not sure how long they have to show that their revenues are down. You haven't said what their experience has to be for that, then that payment to be adjusted because revenues have come down, what the actual time period is, what the experience needs to be. I don't know. And I haven't been able, kind of reading your testimony, to figure all that out, but it just seems to me that there are a bunch of variables there that folks probably may not understand as fully because they're in such dire need of those funds.
Well, that's a good point. And if you take a look at the Virginia disclosure law, there is a requirement to disclose, if payments are variable, the manner in which those payments are calculated and how the payments are collected.
Well, thank you for your answers. Thank you, Mr. Chair.
Thank you, Representative. Okay. I don't believe there's any further questions. So thank you. Thank you for your time today and your patience. Appreciate all the back and forth. Okay. We're moving on. Next on my list, I have Alexis Shapiro. Is Alexis here? Hi, welcome.
Financing. We are a Massachusetts-based fintech company that has provided nearly $2 billion in working capital to more than 45,000 small businesses nationwide. Here in Connecticut, we've provided nearly 500 small businesses with over $20 million in working capital. We are also a member of the trade organization, the Small Business Financing Association. Now, I had a beautifully prepared statement here, but listening to everyone today and the questions, a lot of it has been covered. So bear with me while if a couple sentences are repetitive, but I also have a lot to say in response to things that have been brought up today. The financing product that we offer small businesses is what SB 1032 refers to as sales-based financing. It's a purchase of future receivables, as we've all heard today. Through this product, small businesses receive upfront capital from us in exchange for a set dollar amount of their future receivables. The small business submits those purchase receivables, as we've all heard, to us by sending a percentage, which is typically about 10% of their monthly gross receipts until they've sent us the full amount of receipts we've purchased. This afternoon, we've heard testimony indicating that small sales-based financing providers are predatory, that they are scammers, or they're out to deceive small businesses. That is definitely not who we are. Forward Financing is committed to helping small businesses. In Boston, for example, we've partnered with the Initiative for a Competitive Inner City to offer tuition-free education programs designed to help Black, Indigenous, people of color, and women-owned firms develop sustainable growth strategies. We're working on establishing similar initiatives in other states, and we would welcome the chance to do so here in Connecticut as well. We strive to provide small businesses with the tools they need, both economic and otherwise, to thrive and grow. Our customers have given us thousands of 5-star reviews on Trustpilot, on Google. We have an A+ Better Business Bureau rating. More than a third of our customers return for a second round of funding or more. And as to customer stories, I would absolutely encourage everyone to take a look at our website. We have many, many customer testimonials on there, videos, statements, etc. And I would also be happy to provide any particular stories in writing at a later time. As to sales-based financing, and the reason our customers are so happy with us is that the enormous benefit of this product for a small business is that because we're only entitled to that set percentage of monthly revenues, if a customer's revenues decrease, so too does the required monthly dollars payment to us. If, as happened during the height of COVID, a business's revenues decrease to $0, as we were discussing earlier, for a given month, they owe us nothing that month because 10% of $0 is $0. You can imagine what things look like for us during COVID. Over 70% of our customers had their payments lowered or paused as they made it through COVID. We help many, many customers get through COVID who otherwise would have gone under if they were stuck with a financing product with a strict payment schedule. So if we contract to receive, say, $10,000 in future receivables, that number never changes regardless of how long it takes the customer to pay. While it's easy to use the phrase that APR will somehow provide an apples to apples comparison, in actuality, that's not true at all. This is because, as we've discussed today, it's impossible at the start of a transaction to calculate APR because we have no way of knowing how much on a daily or weekly basis the customer is going to pay us or how long it will take them to pay us what we purchased.
Thank you. If you would just summarize that, buzzer was our 3 minutes.
Okay.
We'll have some questions, I'm sure.
Yep. Well, I'll just say in conclusion that Forward Financing and the SBFA support efforts to mandate transparency in the commercial financing industry. SB 1032, and in particular, the disclosure of APR for sales-based financing, will unfortunately do the exact opposite for the customers it's intending to help. Thank you.
Thank you. So questions, you heard the discussion about collections actions. I just did a quick search on the judicial website. Forward Financing is the plaintiff in 12 cases over the last 3 years. So I don't want you to comment on any of those cases
Yeah.
specifically
Yeah.
if you don't like to, but I just want to get a sense
Yep.
of what your collections practice is
Right.
and the instances in which you would have to sue
Right.
one of your borrowers.
Yep. So if a borrower or if a customer, a small business legitimately runs out of money or the revenues decrease, as we've been discussing, we work with them and we match their payments to their revenues. However, there are small businesses out there who will take funding from us and then essentially disappear. They don't communicate with us anymore. They essentially go MIA with our money. We then have a whole collections team that will reach out repeatedly to them in an effort to get a hold of them, find out what's going on with their business, match their revenues to the payments, and work with them in that way. If we get to a point, which is typically about 30 to 40 attempts at outreach by text, email, or phone, or all three of those, if that customer is still not talking to us, then we will go ahead and bring a legal action against them. And honestly, the legal action is intended to bring them to the table to start paying us again. It's not, we never engage in a seize your assets type thing. We have never used a certificate of judgment or an advanced judgment where the customer would have no opportunity to respond in court. That's just not how we operate.
I see at least two of these actions where forward financing is defendant, which I believe would imply that it held a lien on some other property that was being foreclosed or something of that nature. Is that something that your company would engage in?
Again, if there's a situation where a customer has been completely ignoring us, we will take legal actions intended to bring them to the table. But that is a very small minority of the cases. We've funded nearly 50,000 businesses at this point.
Thank you. Any other questions? Representative Delnicki.
Thank you. Thank you, Mr. Chair, and thank you for coming forward with some hard data. Again, how many of these financial products have you issued and how many have actually failed? Just to get a feel for this.
So again, the number would be about 50,000 small businesses, and many of those small businesses have repeatedly, about 35% of them have repeatedly come back as many as 7, 8, 9 times as they continue to grow to get additional financing. And these are people who are basically often rejected by traditional lenders. So this is a product that is what gets them the impetus for the growth that they're trying to achieve. As far as how many fail, again, the word fail, does fail mean, I mean, I probably don't have hard statistics on either, but it depends on whether you would mean fail, meaning we lose.
Failure to meet their obligation on repaying based on what monies they have coming in, what their accounts receivable is or are.
I mean, I would approximate that's in the high teens percentage. I would have to get you more specifics though, if you want an exact number.
That would be good to know, because I'll tell you, to have some businesses come back 7 and 8 times, that tells me you've got to be doing something right.
And the thousands of 5-star reviews.
Yeah, exactly. And tens of thousands.
It's thousands. I don't know the
Thousands,
exact
okay.
number.
Thousands
And
of
we have
5-star
an
reviews.
A+ rating with the Better Business Bureau.
So apparently, from what you've said, the product works. The accounts receivable, you work with the business person, and you've got repeat clients,
Correct. Many.
quite a few of them by the sound of it.
Yeah, thousands.
And again, if you could provide us that information of how many repeats you have, how many you've actually sold the product to, in essence, and how many have failed, because it sounds like it's working well. Is that a fair statement?
Absolutely. I mean, of course, some fail with any product, some are going to fail, but the majority do not. And again, thousands of very satisfied repeat customers.
And well, I appreciate that. I appreciate your testimony, your answers, and thank you, Mr. Chair.
Thank you, Representative. Senator Miller online has a question. Senator Miller.
Thank you, Mr. Chair, and thank you for your testimony. Just one question. Are you regulated by the state of Connecticut, I mean, Massachusetts, or is there any oversight over the industry there?
There's no direct oversight, as with any industry, we have the state attorneys general that would regulate business practices, but there's no direct regulator that we report up to.
Okay, thank you, Mr. Chair.
Thank you, Senator Miller. And that brought up one follow-up thought I had and was thinking this earlier. We actually have a pending proposal in this committee to increase the limit of small loans, what's defined as small loans in the state of Connecticut, from 15,000 to 50,000. And your loans funding size ever go below 50,000? And I know there actually this bill kind of touches on loan size as well. Would that be anything that would force regulation for your company?
So the advances we put out are anywhere from $5,000 to $300,000.
But you're not familiar with our small loan statutes? There may be an exemption under there or something. I'm not sure.
No, I would have to become more familiar with that.
Take a look. I'm going to do the same. Because again, that's a pending bill that we're hearing next week. That was a proposal from the Department of Banking. So I'm certain it will allow the department to regulate more loans and lenders, but I'm not sure if there's an existing exemption or something like that that would apply. Thank you. Sorry to ask you about something off topic.
No problem.
Anything else, Representative Santos?
Thank you, Mr. Chairman. Sort of, you've answered the question that I have, but again, I'll go back to the way my mind works is through numbers. And Representative Delnicki asked the question. So being that you're from one of these organizations, is there a number that you can provide us for businesses that you have to engage in collection or sort of delinquencies or default or even you have some that you've had to sue, right, for certain reasons? And I don't want to get into those reasons, but I wonder if there's hey, listen, 98% of our loans are great, 2% of our customers have issues. That's what I'm trying to get at.
Yeah, I don't have those numbers with me today, but I'm happy to provide those in writing.
That would be great
as a follow-up.
Yeah, that would be great, because I think that gives us a little more of a perspective of what we're dealing with. Because perhaps some of us just see this on the bad end of it, right? The bad side, when those businesses that are failing and go through a situation like this. Maybe that's what we're seeing. We're not seeing all the other successes, but my personal feeling is that I feel bad for those folks who are going through these issues, and then all of a sudden they're falling deeper in the hole, right? But I would love to get you've mentioned that you've got thousands of reviews and thousands of happy customers, repeat customers, but I would love to know what the number is of folks that you've had trouble with, that you have to end up going after for some reason or another. So
Yeah,
appreciate
happy to
that.
provide that information.
Thank you. Thank you so much. Thank you, Mr. Chairman.
Thank you, Representative. Okay. One other question, Representative Anaskovic.
Thank you, Mr. Chairman. So based upon obviously your testimony, you seem to be on a path of doing it the right way with the
Yes.
repeat customers and doing everything. My question is more so along the lines of when do you provide disclosures to your clients, and what do you disclose to your clients? And are they given an opportunity to maybe bring that information to somebody else to get a third party opinion? Because some people may be afraid to ask the questions, depending upon, the industry that they're in or something that they're doing. They may be afraid to ask that question of you. And it would be simpler for them to ask a confidant or somebody that they, may be able to get some more information from.
Yeah, from day one, our company so we have a funding contract, as anyone would. The front page of it has a big bolded box that says, this is the money we're depositing into your bank account. This is the full amount you will end up paying us in return. And this is, this is how it works essentially, but the numbers are big, bold, and on the front. And that is given to them before they're ever asked to sign the contract. So certainly if they wanted to either shop it around or speak to an advisor, they would have the opportunity to do so.
Right, so that doesn't require them to go through with the transaction, just because you're disclosing to them.
And that's why we're in favor of disclosures in general in the industry. We would love to see everyone required to have those same kinds of disclosures upfront and in bold, because any industry is going to have some bad apples in it. And we would love to, just as much as anyone else, to see those bad apples go away.
Great, thank you. Thank you, Mr. Chair.
Thanks, Representative. Okay, anyone else? No, seeing none. Thank you for your
Thank
testimony.
you.
Okay, next on the list is Dr. Shaka Felder. Dr. Shaka Felder here? May or may not be here. It says in person, but okay, so we can possibly come back if they reappear. Okay, so
Mr. Chair, I think Jeannie wants to say something.
I was just going to say Dr. Felder was in the waiting room and then logged off, so they may be coming into the hearing room.
okay. All right, well, I'll tell you what, I'll keep going and then we'll certainly come back. Next on the list is Luis Luna. Do we have Luis?
And I have not seen Luis log on at all yet.
Okay. Then next would be John Brady from AFT. I think John is in the room, correct? In the Zoom room, that is. He is. John. John Brady, you are up. See, he's active in the room, but he may have. There he is. No, John. There he is. I see John now. Hey, John. Welcome. I think you're still muted. I can't hear you. Or there's maybe an issue with your audio. Can't hear you, John. John, we're going to, John, we cannot hear you right now. Tell you what, log back out and log back in. We will come back to you. Okay. Thank you. Thanks for your patience. Okay. After John on the list is Jonathan Helfat, who's going to be joined by Richard Gumbrecht.
Right. So I'm Rich Gumbrecht, and John's going to plug in as well. Looks like we have our names are the same. I'm Rich Gumbrecht.
Sarah's number 2. So if all he needs to do would be to turn his camera on and unmute, and he'll be ready to go as well. But why don't you proceed? Thank you.
Yeah. So John, hopefully you caught that. There you go. Okay, so thanks, folks. This has been a long day for you, so I really appreciate the fact that you are willing to stay as engaged as you are going through all of this. I am the CEO of a trade association called the Secured Finance Network. We've been around for over or nearly 80 years. We testified last year in front of this committee, and we represent companies who provide asset-based lending, purchase order financing, other forms of secured financing, factoring to small and middle market companies. The products that we represent are collectively underpin about 20% of gross domestic product. They've been used for many, many decades. And to the point about default rates, our default rates over the last 50 years have averaged less than 1% per year. And in the last several years have been less than 10 basis points. So these are products that are repeatable, reliable products that have been used by business for quite some time to fund their working capital needs. Our members sign and attest to fair business practices, which includes full disclosure around the terms of the transactions, We have testimony that was submitted yesterday by one of our members, Min Chen from Stamford, Connecticut, who also testified last year. She couldn't be live with us today, but she is typical of our members who lend to small and mid-sized businesses in the state of Connecticut and object strongly to the APR language in the 1032 measure. And the reason for this is that, as you've heard a lot of discussion on this subject, APR is a consumer concept with a term loan model or provision. The products that we provide are revolving products that are a function of the actual cost to the customer is a function of the amount drawn against the lines and the timing of those draws, none of which can be known at the time that the deal is incepted. And if we were to pick a worst case scenario in terms of what the borrowings might be, that would disadvantage our companies tremendously from a competitive standpoint. If we were to pick a best case scenario of what it would be, it would not reflect the reality of what it would ultimately be as well. And so we have been active in working on with other states on trying to put forth a disclosure model law that still provides significant disclosure, does not include APR, but reflects the actual cost of borrowing. And we've provided to this committee a copy of the detailed disclosure guide that we created for complying with the California regulations. Our members have decided largely that they won't provide loans under $500,000 in California because of the complexity in complying with those regulations and the risk of complying to class action suits because the calculations are not reflective of what the real costs are. So we would ask that you reconsider looking at alternatives to 1032, and we're happy to work with you in that regard. John Helfat, who's with me, is our general counsel and also sits on the Uniform Loan Commission, which was mentioned earlier, which is trying to establish a standard for these measures across states. And John, I'm sure, has some comments he'd like to make as well.
Thank you. Thank you, Senator, representatives. I'm John Helfat. I'm co-general counsel to SFNet. I just want to make two quick comments. When California was enacted and the regulations became known, we felt that what we would do for our members is we would try to provide a guide for them so they knew how to comply with APR in California. We hired a law firm that is familiar with the California statute. We hired an economist to try to do the calculations, and we came up with a 63-page guide. Forms, interpretations, and the reaction of our members was it's still too complicated for us to comply with. And we had pushback from our members because it was very complicated. APR is complicated. So, as Rich said, some of our members even went to the point in saying, why should we lend in California? So there is an alternative. There is an alternative which we would like to discuss or make the legislators aware of. There are 13 states that have considered commercial disclosure legislation. While we hear about New York and California all the time, there are 11 other states that have discussed this. Nearly half of those states do not use APR. They use something called total dollar cost financing. It's a very simple metric. It's basically how much is the borrower going to get, how much are they going to pay for it, and what are the costs in between. It is simplistic. We believe it does the job because it's something that you can easily understand both as the borrower and the lender. And we would ask that the Connecticut legislators either consider what fully 6 of the 13 states are either in the process of adopting or have adopted, such as the state of Utah, because there are alternatives to APR, and we would at least ask that you consider whether that would be something that Connecticut could consider and adopt. Thank you.
Thank you, guys. One question for you, Jonathan, about the Uniform Law Commission and the work that it's doing.
Yes.
What's being talked about there, and what's the anticipated turnaround?
I do not think that it is realistic to assume that anything will come out of the Uniform Law Commission that is usable until 2025. It's in the study stage now. That's going to take a year, and then they'll do drafting. But it is clear that that there is an interest in a uniform law, with every state having different amounts, 200,000, 500,000, 2.5 million. This issue of jurisdiction, does the Connecticut law apply if a Connecticut lender lends in Massachusetts? There's jurisdictional issues, regulation issues. I believe that there will be a uniform law presented to the states, but you are correct, it will not happen tomorrow morning.
Okay, thank you. Any other questions? Anyone? Nope, seeing none. Thank you, gentlemen. Thank you for your patience.
I'm sorry, I couldn't get my hand up quick enough.
Senator Miller.
Senator Miller, sorry. May I, Mr. Chair?
Yes, please.
Thank you. So Jonathan, you had said that there were 13 states considering the disclosure, and 6 of them, what did you say about 6?
Okay, so Senator, there are 13 states that have considered commercial disclosure legislation. Several of the states, the legislation never got enacted. It died in committee. Example, in Maryland, that there is no longer an active piece of legislation. Similarly, on the federal level, there's no longer an active piece of legislation. North Carolina, there's not an active piece of legislation. But the rest of the states either haven't acted, of the 13, haven't acted, like New York and California, and it is working its way through the legislature in Georgia, Illinois, Kansas, Mississippi, Missouri, New Jersey.
So, so either do you know what the disclosures look like? Is it similar, most of them similar to California, New York, or Utah and Virginia?
Okay, so it's split. Example, Georgia, Kansas, Mississippi, Missouri, Utah, they have what is called a total dollar concept of financing, which is a fairly simple metric. New York, Connecticut, Illinois, New Jersey, and the federal legislation, which is dormant, they all have an APR metric.
Right. Thank you, Mr. Chair. Thank you, Jonathan.
Thank you, Madam Chair. Okay. Seeing no one else, thank you, gentlemen, for joining us today.
Thank you.
Thank you.
Okay, now we're going to go back to John Brady, who is back with us.
Yes, thank you.
Okay.
Thank you to the chairs. Thank you. Thank you to the chairs, the ranking members, and members of the committee. My name is John Brady. I'm a registered nurse, and I am the vice president of AFT Connecticut, a union of healthcare, education, and public service members. I come to you today to speak in favor of HB 6689, an act concerning Connecticut Higher Education Supplemental Loan Authority refinance loan subsidy for certain healthcare professionals. We are in the midst of a healthcare crisis, which is contributing to a safe patient care crisis. There are 2 aspects to this crisis: recruitment and retention in our professional healthcare workforce. Nowhere is this crisis more acute than in nursing and in mental health providers. HB 6689 seeks to address this issue by providing subsidies on interest rates for loans to healthcare professionals working in a clinical setting. It will assist recruitment by lessening the financial burden on healthcare workers and assist in retention because continued work in the clinical setting is a condition of eligibility. I thank the committee for raising this bill, and I look forward to its passage. And thank you all for the work you do for the state of Connecticut.
Thank you, John. Appreciate it. Thanks for your patience and coming back, logging back in. I could hear you loud and clear then. And thanks for your advocacy on this and prior discussions. Just one question. I wonder if you were able to have any ballpark determination of how many professionals you think either within AFT or statewide would be potentially eligible to refinance their loans if we pass this.
I don't have that information, but I think that anything we can do to help people refinance loans and to get into the professions and stay in the professions, I think is helpful.
Yeah, agreed. I know it's hard because I guess the hardest thing to determine is how much student loan debt somebody might have. But yeah, any statistics that you may come across that would help, because I think this is we're casting a pretty wide net, and as you said, it's important, to do anything to help with hiring and retention in this industry. But I think as this bill proceeds further, it's going to be incumbent upon us to determine the size and scope of it in order to estimate how much we would need in terms of the funding to make this impactful. So appreciate your testimony. Any other questions for John? Seeing none. Thank you, John.
Thank you.
Okay. Next is Winston Berkman-Breen, who is with us online. And there's Winston. Winston, welcome back virtually to the Connecticut General Assembly.
Great. Thank you so much, Chair. Well, good afternoon, co-chairs, ranking members, and members of the committee. My name is Winston Berkman-Breen. I'm the Policy Counsel and Deputy Advocacy Director at the Student Borrower Protection Center. The SBPC is a national nonprofit committed to ending the student debt crisis. Prior to joining the SBPC, I was the student loan ombudsperson for the state of New York, housed in its financial regulator, the Department of Financial Services. I also want to note that the SBPC is a proud partner of the Connecticut Student Loan Fund and its members, and we heard from Chris and Ann, who testified earlier today. So I'm testifying in support of HB 6690, which would create a student loan registry in the state of Connecticut and establish an office of the student loan ombudsperson. So last year, the legislature convened a post-secondary education financing working group to study the student loan market in the state. I was a member of that working group. In our discussions, it quickly became apparent that we did not have reliable and specific data about the private student loan market in Connecticut, and there was simply no complete data set or report on it to draw from. Part of the reason there is so little information is because many of these lenders are not required to be licensed in the states in which they operate. In Connecticut, you don't need a license to be a consumer lender unless you lend at rates greater than 12% APR. This is true across the country at varying levels and is not unique to Connecticut, but it makes it harder to identify bad actors and more expensive to operate as an honest lender. So that should be concerning, as the private student loan market in Connecticut is likely a $1 billion+ industry, and the state simply doesn't know who is making these loans. It's also concerning because the shadiest lenders partner with for-profit schools that offer high-cost, low-quality educations and leave students in debt, and particularly target communities of color. Several states have started to address this issue by requiring these companies to tell the state that they're operating in their jurisdiction and to provide some annual reporting. Maine, Colorado, Illinois, California, and Louisiana have done this. Other states have pending bills, each in slightly different ways, but they're gathering the same information, not just about the outstanding debt and number of borrowers, but about who is making these loans and what companies are active. So HB 6690 would give Connecticut comprehensive annual data about student lenders operating in the state. This will improve policymaking and identify standout good actors as well as outlier bad actors. And it makes sense. The state has the authority to do this and should want to know what's happening in its jurisdiction. There are some minor amendments that I think could be added to the bill as it was raised. They're very technical in nature and just reflect some implementation lessons learned from other states, and I'd be happy to follow up with the committee on that front. They don't address the bill's substance, again, just implementation and clarity. With respect to the ombudsman provision of the bill, I can say from personal experience that it's an important role both in helping individual borrowers navigate the student loan landscape and in making sure Connecticut borrowers have someone actively representing them and their interests at the state and federal level. We've seen this as a very powerful resource in over a dozen states already across the country. I want to be clear that the need for an ombudsman isn't a criticism or a ding against the Department of Banking. They're a national leader as a regulator. It's just the ombudsman role is different in kind, and there's a great need for it in Connecticut. So with that, I urge the committee to vote in favor of HB 6690, and I'd be happy to answer any questions you might have.
Okay, thank you, Winston. Thanks for joining us. Thanks for participating in the task force back in 2021, right? A couple of questions for you. Based on your experience, I think you're a good person to answer them. One is that I asked earlier about in the other states that have ombudsperson or student loan advocate or whatever name it may go by, where in state government is that office housed? Is it within the financial regulator's office or elsewhere?
So it does vary, and I believe Anne sort of mentioned this, but happy to add more color. So there's about 12.5 states that have done this, and they are mostly in either the financial regulator or the attorney general. Where we heard earlier, Colorado is an example of it being housed in the attorney general. Colorado's financial landscape is a little bit different. Their attorney general also serves as their financial regulator, but Illinois is an example of the attorney general separate from the regulator housing the student loan ombudsperson. I think either of those models is appropriate. I'm a very big believer in personnel as policy, so it really matters which office is going to be able to lean into it, the attorney general or the regulator. You also see models where they're housed in the treasurer or in the education oversight body. I don't think those are quite as effective because they don't have law enforcement authority, they don't have information gathering tools, and I think both of those are important to have peripheral to the ombudsperson themselves.
Thank you. That's helpful. A second question is, with regard to the registry, I believe there are some other states that have done this. One of the questions that we had last year with this legislation was, what would be the cost and what the manpower required to stand up that division or that particular function within the in our case, the Department of Banking. Anything you can offer on that from other states' experience?
Certainly. So I want to take a moment to remind everyone sort of the distinction between registering, which is what the bill would do, and licensure, which is what other student loan servicers are generally licensed, small dollar lenders are licensed, et cetera. Licensure is a very involved process. You have to review applications to become licensed. You have to then grant the license. You regularly audit or examine that company as a result of them being a licensee and being very closely supervised. And that takes real staff and FTE time, and I appreciate that. With a registry, the state and the Department of Banking as an actor of the state is not taking it upon themselves to actively review or regularly go in and check the books of these companies. They're merely saying, we're going to add your name to a list of people that we know are doing this business in the state, and then you're going to give us an annual report every year. That report then gives them a great basis to decide, what, it's worth us investing some resources to go into this company or that company, but it doesn't become an annual cost or an annual activity. So I wanted to just make that distinction between licensure, which is a very common thing, and registry, which is also common, but is a significantly lighter touch and lower cost. Colorado, I think, is the state that is most advanced in terms of having stood up its registry and the public-facing components of it. And the method they've taken is, I think, appropriate, but very light touch, which is that they basically created the online website for the companies to come and become educated about their responsibility to register and to submit annual reports. And they'd have a template up there that the companies have to fill out and return. And what Colorado does is it basically just uploads those to a public-facing website. They don't have to do synthesis or analysis or put it together as part of that maintenance of the website. They do, as I said, if they find outlier information when reviewing the reports, they can decide to invest time and staff into investigating that. But the actual mechanics of operating the registry are pretty light touch. And as far as I know in my conversations with them, they haven't had to bring on any additional staff. It sort of exists in, for them, at the Ombudsman office, which I mentioned, is in their Attorney General's office. So there's always a little bit of administrative costs, but my experience has been that it is not to the tune of hiring a new division or investing in new technology or anything like that.
Okay, Thank you. Appreciate it. And we may follow up or maybe ask our staff to try to do so to determine what the actual line item funding would be. Because, again, as you're describing it, it sounds like there's definitely some administrative cost. And I guess we could go, we could discuss further, if you needed. Maybe.
Certainly. And just as a note, and whether I can't recall offhand, sorry, whether this is currently in the draft, but it's certainly some of the proposed amendments I would offer to the committee. Other states have included a registry fee, right? So it can be somewhat self-funding. Of course, it depends on what the actual costs are, but it is not a unfunded mandate, so to speak. There is the ability to impose a fee upon entities as they register.
Good suggestion. Okay. Any other questions for Winston? No. Oh, Representative Paolillo.
Just one follow-up, Mr. Chair, to some of your questions. Winston, thank you for your testimony. You mentioned some of the administrative costs, some of the other areas of concern with capacity. Have you had any discussions at all or conversations with our banking department here in Connecticut around some of those issues?
Thank you for that question. And not this session. Last year, the banking department was involved in the student loan working group, and it came up, which Representative Doucette and Senator Miller participated in as well. And it came up in those contexts and in hearings thereafter, but it's been about a year, and I haven't had any conversations with them this session.
Thank you. Thank you for your answer, Mr. Chair. Thank you.
Thanks, Representative. I just noticed Senator Miller as well has a question.
Thank you. Winston, thank you for joining us once again. You always bring a wealth of information. Winston, I want to talk about your position as the former ombudsman for New York State. How large was that department?
So I think we heard some testimony to this before, that it has grown. And I should say that although I have a very good, I will answer your question directly, but I just want to be clear that I'm still in my 2-year cooling off period from working directly with my former agency. And so I'm not up to date on what they've done since, because I'm prohibited from New York State ethics rules from engaging with them and learning on that front. So it could be different. So I was part of a team of probably about 5 or 6 people. I will say I was one of only 1 or 2 people who did what you would think of as ombudsman roles. And that's because we were simultaneously licensing and bringing on that whole industry, which Connecticut has already done. So the other folks who touched on the student loan servicing work were very involved and very busy, I should say, doing the licensing, doing the onboarding of that industry. And so it was really me and my colleague, and probably about half of his time, who took over from me and is currently the student loan ombudsperson for the state of New York. He and I together would do the complaint resolution and sort of advocacy and monitoring federal, state, and local information and the education component. But there were about 3 or 4 other full-time staff sort of in that space, but they were mostly doing the nuts and bolts and mechanics of regulatory licensure of the industry.
Thank you.
Thank you, Senator. Okay. Seeing no other questions. Thank you, Winston, once again for joining us.
Thank you, and have a great afternoon.
Okay, I see Luis Luna is back with us. So I'm going to call on Luis now. Welcome, Luis.
Thank you so much. Really happy to be here. Well, dear members of the Joint Banking Committee, my name is Luis Luna and I live in New Haven. I am a member of the Student Loan Fund Borrowers Collective, and I'm also the coalition manager for Husky for Immigrants. Today, I'm speaking on my own personal experience as it relates to student loans. So I entered college in the fall of 2003. I was a low-income immigrant student, and as a student in high school, I had very little support or guidance to navigate the college application process. I knew that I was passionate about art and design. So when I saw an ad on my computer for the Art Institute of Philadelphia, I was super intrigued. I contacted the school, and when they invited me to visit, they talked up their photography program and promised that financing would be very accessible. I applied and I was immediately accepted. The financial aid office encouraged me to fill out Sallie Mae student loan applications, telling me not to worry because I was sure to secure a high-paying job after graduation, which would allow me to easily repay my loans. As a young person with English as a second language, and 18 years old. I believe the optimistic picture they painted of my life and financial future. So 3 years later, as a junior in college, my mother was injured at work, leaving her incapable of rejoining the workforce. I left the Art Institute, and returned home to support my family. And when I started to work at minimum wage, it really dawned on me how enormous my student loans were compared to my meager income. Even worse, when I matriculated, they told me that I could transfer credits. But when I tried to transfer credits from the Art Institute to Gateway Community College, I learned that not a single credit from my 3 years at the Art Institute would transfer. And to complete my degree, I would have to take out even more student loans, and it left me pretty devastated. My student loans have followed me throughout my life with an average yearly school cost of $43,000. $47,000, my loans have grown to a total of $100,000. This debt has made it difficult for me to live a full life, pursue good work in art and design jobs. I became an organizer, and I have worked on issues around economic justice, social. I have worked on issues around economic, social, and racial justice. I still dream of finishing my bachelor's degree. I am currently enrolled at the Cumberland's University in Kentucky, taking online classes. And although my school was closed and lawsuits have been filed against the Art Institute of Philadelphia for defrauding students, I still owe about $100,000. I am one example of many students who found themselves being taken advantage by schools and having little to no support in navigating the system. I joined the Student Loan Fund Borrowers Collective because I wanted to change the predatory systems of student debt and higher education that impacts people of color and first-generation students like myself disproportionately. Today, I urge the Banking Committee to fund a student loan ombudsman and implement a private student lender registry. So please support this bill.
All right. Thank you, Luis. Appreciate your testimony and your firsthand experience. Just one question for you that I think will help to add some context and some color to what we're talking about today. Have you had any success or have you made any attempts to engage in like an income-driven repayment program or deferral of any kind with your lender, and what have those efforts been like?
Yeah, so throughout the last 15 years or so, I have been able to. Well, I have applied for repayment that is tied with my income. It has been difficult because finding a good paying job without a bachelor's degree has been difficult. For over a decade, I worked as a bartender, I worked as a server. And I think for me, the only opportunity that I had for a job that pays well has been in organizing. So I worked at Make the Road Connecticut, I worked at Working Families Party. But it has been very difficult for me to pay off my loans, because even though the jobs that I have had that are secure in the last 5 years or so, it hasn't been enough for me to pay off like all of my debt. There has been periods in which I was very optimistic to be able to like pay my loans. I remember back in maybe 2007 or 8, I had agreed to pay about $700 a month from a company that had bought my debt. It was a private company, and somehow I had agreed. I was still a young kid. I was like maybe like I was much younger, and I haven't had like much guidance on this. But I had agreed to make $700 payments, And then I was able to keep up with it for about 6 months or so. And then, you know, I lost my job as a medical interpreter. So I fell off, and then that I just don't know. I don't understand how this works, where like, you know, I try to pay this off, but because I don't have a bachelor's degree, like it's very limited for me to find jobs that pay well, except for my organizing. I think like that's where I have found sort of like my sort of like my calling right now. So yeah, it has been complicated. It has been a bit complicated.
Yeah, no, I appreciate that's helpful for us to hear. Again, navigating the system and trying to find where those options are and what they might be, you know, your, you know, ongoing, you know, financial constraints and everything else that you need to do to repay those loans, I think shows, you know, what the benefit is, that any resources that might be made available would be helpful. I can see.
Yeah, and also, if I may, I had applied for the program that for loan forgiveness last year, but you know, we know that the federal government, that it's been sort of like we don't know exactly what's going to happen, but yeah, so like you know, I've been trying to, and it is difficult to sort of like navigate all and sort of understand where loans are going to, like who is servicing them, and sort of like, you know, having transparency with, you know, how these companies work.
Understood. Okay, any questions for Luis? No? Seeing none. Oh, Senator Miller.
Sorry, it's the trying to get this mouse to move. It's hard to raise my hand. Luis, thank you so much for testifying today and just giving a story behind the work that we're trying to do, and how important this position is. But I just want to give you a word of encouragement. You know, even if you have a bachelor's degree, it's hard to find a well-paying job. I had a bachelor's degree probably before you were born. And it was very, very difficult to find a well-paying job. And even today, it's very difficult to find a well-paying job. So don't be discouraged because you weren't able to complete that task. And I hope your mom is doing better now. But, you know, thank you for the work that you're doing, because there it is, the calling to be an activist and to fight the fight that you're fighting for the undocumented, and as well as for the students. It's because of your story that we are able to look at legislation today. So thank you again for being here today and sharing your story with us.
Thank you, Senator Miller. Yeah, I appreciate those words. Yeah, and I do feel lucky. I mean, I lead a coalition that is doing really amazing work, and I'm really proud of like the folks that I work with, and I'm the only within our coalition. I'm the only person who is salaried. You know, so I do want to, you know, mention that, like I feel like really grateful for like the work that I do, and also for the trust that like the people who I work with have put in me to this. And yeah, it's great to sort of like share my story, because I often don't share the story of like how difficult it has been to sort of like have over $100,000 of debt under my name, and just how difficult it is to pay that off. But I do appreciate your words, Senator Miller.
Thank you, Mr. Chair.
Thank you, Senator. Representative Santos.
Thank you, Mr. Chair. Luis, thank you. Again, I'm going to echo some of Chairwoman Miller's comments. You know, there is a difficulty when it comes to situations like yours. I've got a good friend of mine who just graduated from law school, and you know, he's 27 years old, and he's all these years of schooling, and he's going to end up in a good job at some point, but he's settled with all this debt for now, right? And in most places where he's looking to rent an apartment or do anything of the sort, he you know, the debt that he has incurred is now part of the estimation of his ability to pay back right? So, there's more that we can do. And in another fashion, I also relate to your story very much, having been, coming to this country at a young age, not speaking the language. I remember the struggles that my parents and my brothers and sisters went through, and knowing what it's like to being undocumented, working yourself up to being able to reach the documentation status, and then going to school like you did. So I commend you for that, and all the work that you're doing. And I agree with you 100%. There's more that we can do for folks who are settled with so much debt after achieving the dream of a college education, and that it sort of inhibits them from being able to do other things in their lives. So thank you so much for coming forward and telling a story that perhaps most people don't want to share or have some kind of a hesitancy to share, but your story does help us with the work that we're trying to do through this bill. Thank you very much.
Thank you. Thank you so much.
Okay. Well, thank you, Luis. I appreciate you joining us this afternoon.
Thank you.
Okay, next on our list is Chris Grimm. Chris is on Zoom. Welcome, Chris.
Hello, Chair Doucette, Chair Miller, Vice Chair Santos and Cohen, and ranking members Delnicki and Berthel. My name is Chris Grimm with the Innovative Lending Platform Association. ILPA is a leading trade association representing online small business finance providers and servicers, and we are testifying in support of SB 1032 with a small amendment request. ILPA supports disclosure in small business financing. We supported legislation in New York and have supported similar legislation in other states. Our small amendment is to clarify between providers and brokers. The definition in the bill of broker is quite broad, that it would encapsulate some fintechs that are covered as providers in other states. And so our amendment would take what New York tried to do in their regulatory process, add a new definition for financer, and make sure that it's clear that a financer is not a broker, but financiers would still fall under a provider and would have to provide the disclosure to the recipient. I'm happy to answer any questions, but otherwise, we support the bill, and with that one fix would be 100% supportive. And so once again, ILPA, I'm happy to answer any questions.
Thank you, Chris. Did you submit those suggested amendments in writing with your testimony?
We just hammered out what that amendment would look like. So I just emailed it to you a little bit before this hearing started, Mr. Chair, but can share it with the whole committee if that's helpful.
Okay, I will look out for it. And then, while we have you here, just one question: if you could speak to the complexity, or from your perspective, how the complexity could be resolved for calculating APR.
Our members don't view it as a complexity problem. It's something that we've been able to do for a while, even before New York or California enacted their laws. So from our perspective, it's not an issue to calculate.
But again, for the benefit of those who may not have been here last year, there are software programs and the like that can calculate it. Is that correct?
Yeah, I mean it's an equation like any other calculation, and most of it's automated programming that we use to do those calculations. So I can't speak for anyone else, but I know for our members, it is not a difficult calculation to do.
Okay, thank you. Any questions? Any questions? Nope, seeing none. Chris, thank you for joining us.
My pleasure.
Patience. Okay, and I think we are to our last speaker, who is on Zoom with us, and that is Betsy Mayotte. Betsy, there you are. Welcome, Betsy. Betsy, we lost your audio.
How's this?
That's perfect. Thank you.
So, you know, when you have two mute buttons, you have to make sure you take both of those mute buttons off. Thank you for allowing me some of your really valuable time to speak to you in support of House Bill 6690. My name is Betsy Mayotte. I'm the president and founder of a nonprofit organization called the Institute of Student Loan Advisors, otherwise known as TISLA. TISLA's mission is to provide all student loan borrowers with free, expert, unbiased, and neutral student loan advice. And the reasons I'm here supporting the state of Connecticut funding a student loan ombudsman office are the exact same reasons that I founded this organization. I've been working in the student loan industry in a compliance or advocacy role for over 25 years. And through that experience, as the years went on, as the student loan programs have become increasingly complex, we unfortunately have seen an increase in student loan scammers. And the number of student loan borrowers, especially the more vulnerable borrowers that are seeking access to advice on how to navigate these complexities, but specifically from somebody that has no vested interest in their loans. One of the things that caused me to leave my job and start this organization was my discovery of the number of student loan borrowers that were going to places like Facebook and Reddit and getting advice on such an important, impactful issue, financial issue to them from internet strangers that may or may not have any experience with student loans at all. Since TISLA opened its virtual doors, our volume has doubled every year. And we need more resources like this rather than less, which is why I do encourage you to fund a robust student loan ombudsman's office. Not only do student loan borrowers need just general everyday advice on how to navigate and best manage their student loans, they also need assistance with disputes. Here at TISLA, we spend a lot of time helping borrowers wade through the noise of inaccurate or just inaccurate and not taking the borrower's dispute seriously for borrowers that do appear to have disputes with their loans. A lot of these loans are older loans. These borrowers need people that have expertise in not only what today's rules are, but what the rules were 20 years ago. Not that long ago, someone reached out to us to see if we could help a borrower who received a bill in the mail for $1 million for a Perkins loan that she thought had been forgiven back in the early 90s and hadn't received a bill or a phone call or a pigeon on the windowsill about that loan since the early 90s. Because we were aware, because I've been in the student loan industry since the earth cooled, I was aware of what the rules were back in the 90s for Perkins loans, and I was able to work with her loan servicer as well as the institution. The loan should, not only should she not have gotten a bill for $1 million, the loan was forgiven back in the 90s and we were able to resolve that, and she didn't end up owing a penny. And there needs to be more offices, and the citizens of Connecticut deserve to have an office that's dedicated to help them, maybe with not such extreme issues, but issues like that.
Thank you, Betsy.
I do encourage you to look at my written testimony. I've included some data that you might find helpful, as well as some testimonials specifically from borrowers that we've worked with that have identified themselves as Connecticut residents, so you can see the impact that such an office can have.
Thank you, Betsy. Appreciate your testimony. Where are you out of?
Well, we serve virtually, but I am currently sitting in Plymouth, Massachusetts.
Okay. And but you have assisted borrowers in all 50 states?
100%. Yep.
Okay. And do you partner with the institutions or with servicers, or how do people find you?
So we're small but mighty. People find us through Google search. We get a lot of word of mouth referrals. We also work closely with employers, other state student loan ombudsmen, other associations to provide proactive education to their constituents, and borrowers hear about us through that as well.
Okay, so that's interesting. And that was sort of where my thought was going too. You work with other student loan ombudsmen and student loan advocates in the governmental setting.
Yes, it takes a village to address the student loan debt crisis. But yes, we've worked closely with quite a few of the state student loan ombudsmen.
So you would get like a referral, in other words, from there.
Well, we work with them
Or
in
you would
different
refer
ways.
them to the office and vice versa, kind of work together on behalf of that borrower.
Yes, we work with them in different ways. Sometimes it's on an individual borrower basis. Sometimes these offices are reaching out to us to ask for our advice on how to handle a particularly sticky situation. There's been recently, we partnered with several state ombudsmen to offer increased support as they did public service loan forgiveness outreach because they weren't able to handle all the volume that they were getting on their own. We also work with them, and I really think this is super important, to help them provide proactive student loan education to their constituents. It's not just about helping the borrowers on the back end, it's helping them be able to educate themselves to manage their own student debt, and we work with them on those projects as well.
Great, very interesting. Thank you. Any questions for Betsy? No? No? Okay, seeing none. Thank you, Betsy, for your patience with us today. Appreciate your testimony. Okay, so with that, I believe, Madam Clerk, that is everyone. I'm not sure if there's anyone who we skipped over that was signed up that may have surfaced.
That is everyone. You did a great job.
Great. So I'm going to close this public hearing for today. I appreciate everyone's participation. And we'll see you next week. Thank you.
Thank you, Mr. Chair.